Good morning, everyone. It's 9 a.m. from the Nasdaq market site in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance Live. Here's your morning rundown. A sell-off in the bond market is threatening hopes for a soft landing. Yields on the 10-year Treasury hit a 4.8% marker before retreating a touch. That was the highest level since 2007. The sell-off coming on the heels of Fed official comments signaling for a higher for longer rates path. The shift also triggered a downturn in stocks both in the U.S. and abroad. And it's only Wednesday.
And he is out. What now? In a historic move, the House voted to remove McCarthy as Speaker, but it's not clear who is going to step into the role, and there doesn't seem to be a plan. Reminder, we've got a little over a month left before Congress needs to avert another government shutdown. The timing is not ideal.
And Ford has made an offer to the UAW. The agreement is the seventh and strongest the automaker has made since August, offering big boosts in wages and benefits and no job losses to EV battery plants. The new contract would run through 2028. No comment yet from the UAW.
Starting with the top story of the day, Kevin McCarthy, he is no longer House Speaker after a historic 216 to 210 vote removed him from the position and left Representative Patrick McHenry in temporary control. But the power struggle remains as the government still faces a looming shutdown and an upcoming election. Brad, we're just about 6 weeks away from that November 17th deadline, the new deadline here for the House, for lawmakers, as well as the Senate, obviously, to reach a deal on spending in order to avert a government shutdown. Yeah. Now, with the House leaderless, lots of questions about who will potentially succeed McCarthy here after he said that he is not going to run again for House Speaker. It really just shows, one, the House is in chaos, two, how divided the GOP party is, and then three, obviously, questions about whether or not anything substantial can get done here within that very narrow time frame.
Yeah, there's a few things at play here. And of course, with the timeline that you mentioned and just weeks out from that particular momentous occasion, one way or the other, we're going to need to see some type of deal net out to avert a shutdown once again. But then additionally here, we're just 13 months out from a general election here again in the U.S. This type of disarray, this type of discord that has really been present here, you got to wonder how that is playing out among voters, where it perhaps shifts some of the priorities that they vote upon here. It's interesting. I was looking through some of the Pew research, and what that really points out most recently, and this was about mid-September that this report was released, so all in, it was the lead up to the need to avert a government shutdown. But then additionally, even thereafter, it'll be interesting to see where some of the inclinations shift in terms of some of the results that came in. Here were the results. The trust in government is typically higher among a member of a party that controls presidency. However, when you look at the trust in government right now overall, it is at some of the lows since they've been tracking this. And that is not spelling out a good thing going into, once again, November timeline that you were mentioning, but also even more so a general election in 2024.
It almost seems like this is obviously a lose-lose scenario or situation for both sides of the aisle. When it comes to some of the pressing issues here, the House has now recessed until October 10th. So that's important to keep in mind here. And until a new speaker is chosen, they likely can conduct votes on the legislation that is needed to really get anything done to avert that government shutdown. They won't be able to most likely vote on some of those pending fiscal 2024 spending bills.
Yes.
So, of course, the risk that then poses to the markets, to the broader economy, something that investors and really all Americans should be closely watching.
Spot on. Well, stay tuned for our conversation later on in the show. American political consultant James Carville at 10:30 a.m. Eastern Time. You do not want to miss that.
Plus, our very own Jennifer Schonberger will have an exclusive interview with Massachusetts Senator Elizabeth Warren. That's coming up in the 11 a.m. hour today.
Well, long-term Treasury yields paring back gains this morning. The 10-year just over 4.7% after hitting peaks not seen since the 2007 financial crisis. The 30-year briefly traded above 5%, now hovering at just below that. Investor Bill Gross, known to many as the Bond King, said in a recent interview that he sees the 10-year going to 5%, as well as saying, quote, "I think maybe 5% caps it for the near term. It depends, of course, on inflation. Depends on economic growth." Here with his analysis of the market, we've got Thomas Martin, Global T Investments Senior Portfolio Manager. Thomas, just good to have you here with us this morning. 5%, do you believe that's in the cards for yields?
Great, thanks to be here. And of course, 5% is in the cards. It's just a question of if it actually comes true and how long. We've been talking a lot about how this latest move in the last week and just the last couple of days has been so fast and furious and truly unprecedented, not to overuse the term, but that there was a likelihood of a correction. Things don't go in a straight line. And so a snapback in yields, which is what we're seeing this morning, was certainly a possibility. So we may never get to 5. But we may get to 5. There's a lot of technical factors going on that are increasing pressure on rates. But the economy is sort of smoothing out.
And Thomas, what are some of those biggest factors that you just mentioned, just in terms of the pressure that we're seeing on rates?
Well, for one thing, a lot of people have lost money in bonds this year, if not probably most people. And the currency, our currency, has increased, I think, also unexpectedly. And that's put pressure on other governments, particularly China and Japan, who need to defend their currencies and who have been buying Treasury bonds. I mean, they do that in the normal buy and sell course of business. Japan has said they have not intervened yet, but they do stand ready to. So there are currency issues with some of our biggest buyers of Treasuries. And there's a lot of supply coming on, and the Fed is letting their balance sheet run off. So there's a lot of upward pressure on that supply-demand balance that needs to kind of work itself out.
Letting their balance sheet run off. Thomas, you also believe that there's going to be at least one more potential raise in 2023. If we do see that, what does that set up for 2024?
Well, the dot plot shows that there will be not really any interest rate cuts in 2024, and the market has moved more towards that reasoning. Really, it all matters what happens to the economy, and we're poised here on that point in time where the lagged effects, the long and variable lagged effects, are really starting to come due. I mean, it could have been 6 months ago. And it could still be 6 months from now, given the strength of the consumer and the labor market. But it's still very likely to be coming. It's just hard to be patient for that. And so we're going to get a lot more information into 2024. And there's a lot more opportunities for something to break, which might also impact Fed policy.
Thomas, what do you think the probability of a recession is at this point, given the massive jump that we've seen in yields and given the fact that maybe the Fed is not done yet?
Well, I put the odds of a recession at about 50-50. And, that's sort of in line with a number of the different indicators that you can see, which would be anywhere from, 40% to 60%, kind of chopping off the outliers. So it's still very much a toss-up. And this idea of the lagged effect of rates just hasn't come in yet. And I think that's the thing that is the most surprising to people. I mean, today's payroll number, today's employment number was actually a bit weaker. And we're in the bad news is good news currently for that. So, but, bad news can turn into bad news if it starts to accelerate. And instead of having gains in payrolls, you have declines.
All that considered here, from what we're seeing in the wages within that payroll number as well, seeing a steepening decline in jobs this month, Naylor Richardson said, chief economist over at ADP. Additionally, seeing a steady decline in wages in the past 12 months. What does that spell out to you about the consumer and how long that, according to you and in your notes, you had said that the consumer perhaps is not, entirely in peril right now, but certainly the situation is showing some weakening right now.
Yeah, well, you're absolutely right. And that came through in the numbers today and delivered through wages. And so as those soften and people start to feel as though they've already spent a lot of money and they've already had experiences and they've already said, casting to the winds, what happens tomorrow or next year or 5 years from now. Eventually, if that becomes biting enough, they will change their behavior. But it does seem as though there's this room for the consumer to have changed as a result of COVID and as a result of the lockdowns, and that to some degree, at least there's been a short-term change in the culture to have fun now and spend now rather than kind of pulling in your horn. But that all does change if the data accelerates to the downside.
So, Thomas, what does all this mean then for investors? If you're looking to put money to work, or if you're looking maybe to reposition your portfolio, what should they be doing right now?
Well, it's important that investors always keep in mind their long-term investment objectives, and that their short-term objectives are met by less volatile asset classes. So to the extent that you know what both of those things are, there's really no reason to change your asset allocation if it's correctly matched up to that. However, if you feel like you've been taking too much risk at this time, it's probably a good time to reevaluate how much you want to have in the truly risky assets. If you need cash for the next year or even year and a half to 2 years, probably not a bad idea to make sure that that's in cash or some degree of bonds for now. And the rest of the money that is for longer term, I think it can still have a good long-term outlook for stocks.
All right, Thomas Martin, always great to get your insight there. Global Investments Senior Portfolio Manager. Thanks.
Great, thanks for having me.
Well, earlier this week, two scientists who laid the groundwork for the COVID-19 vaccine both won the Nobel Prize in Medicine. And the impacts of their contributions will be felt for years to come as Moderna is making its latest vaccine to target both the flu and COVID-19. Let's go to Yahoo Finance's Anjali Khemlani, who joins us now with more. Anj.
Thanks, Shauna. Yes, we are getting the top line results for the flu and COVID combo vaccine. And here to speak with me about it is Moderna CEO Stéphane Bancel. Stéphane, great to see you again. Tell us about these results. I know they're interim and early stage for this combo vaccine, but this is the second vaccine that looks at flu that you now have results for.
Yeah, good morning, and thank you so much for having me. So indeed, it's an exciting day today because we always believe that the combination of different vaccines is the way to go for consumers, for healthcare professionals, and for payers. And so today, we announced positive data for flu plus COVID combo. We are working hard to start the phase 3 before the end of the year. Because it's an immunogenicity study, meaning we do not have to run efficacy study because we have efficacy on flu, which is positive. We shared that recently, and on COVID. We should be able to get the data in 24 and getting ready for a launch for the fall of 25. So if you think about it, really exciting for Moderna. RSV is being reviewed by the regulator as we speak, should launch in 24. Flu now positive phase 3 data we announced at our R&D day a couple of weeks ago, so potentially launch for 24. And then this flu plus COVID could be launched in 25. So that's 3 products that we could launch over the next 2 years. So that's exciting.
Absolutely. And I know that's a message you've been trying to push, and your CFO told us now you have the big 3 with all those results. Talk to me about that, because it seems like there's definitely an aggressive push to get more attention on the pipeline, so you're not just deemed a one-product shop. I know that there's been some analyst concern about that, especially after R&D Day. We got one analyst from Leerink saying, quote, that the revenue projections continue to reflect the asset's poor competitive position in flu. So I wonder how you're thinking about that and sort of the reaction you're getting despite the 15 products in the pipeline and getting ready to launch, 3 new products soon.
Yeah, I think a lot of people are still very focused on the COVID sales. The COVID sales, of course, are important. As you've seen the data, and it's only a few weeks, it seems that the start of the fall vaccination is actually ahead of last year. We are seeing strong demands. I've talked to a lot of leadership at the pharmacy, retail chains, and the wholesalers. Everybody said they're seeing higher demand than last year, which is great. And so we believe COVID is not going away. We believe we're going to have sales of COVID, in 23, of course, in 24 and 25. And then as you launch the new product, RSV and flu, and then COVID plus flu, you're going to see a reacceleration of sales. And then also cancer. As you know, we have said that we should have 3-year survival data available before the end of this year. That's very exciting. If the data is better than the 2-year survival data, which is what I personally believe, because of survival curve, if you look at ASCO, is flattening for people on our drug. That could mean potentially an accelerated approval, which is another piece I think that the market doesn't believe into. So we just continue to work hard on making sure we bring medicines to patients. I believe people are going to start to see the value of this platform. The other piece too is we're already focused on profitability. We've said at R&D Day that we are right-sizing our manufacturing footprint, and we want to make sure our COVID business is profitable. And so I think as the market will see that we are making things happen, things will take care of themselves. We are focused on delivering great products for consumers, and we think that things will follow up from that.
Definitely. I know the right sizing is, of course, important because you're not doing a global pandemic level anymore. Talk to me about the COVID rollout in the commercial market in the U.S. A little bit of a hiccup on distributor side as well as on the insurance side. I want to focus on distributor because that goes back to the cold chain issues. I heard there was some, thawing that needed to be done and the like. So how are you looking at, next year and also all the other products and what it means to be in the commercial market now with this process?
Yeah, so I think indeed, as I was saying, the pharmacy chain and the wholesaler, I think, underestimated the demand and how quickly people, right after the FDA approval on the 11th and the CDC recommendation on the 12th of September, will want to book appointments. That is great news that people want to be protected. As you know, COVID cases have been bubbling up in the last few weeks, since August. And it's not surprising that a lot of people want to be protected. The good news I forgot to mention on the flu plus COVID is that it will not need to be frozen. Same thing with the flu product 1010, the phase 3 we announced, at R&D Day. This new generation of mRNA product are going to be stable in fridge storage, regular fridge, not frozen anymore. They will all be available in pre-filled syringe, which we just launched the COVID product a few weeks ago in pre-filled syringe, which I got great feedback from pharmacists. I was in a few pharmacies, last couple of weeks, and the pharmacists, with a big smile, saying, thank you, it makes my life much easier. If you think about RSV that we're going to launch next year, there are 2 products on the market now. One of those requires 9 steps of a pharmacist to prepare the product, which is lyophilized, it's dry powder. The other one is 5 steps, where the Moderna product next year will be in a pre-filled syringe. You take it out of the fridge, and you just inject to the consumer. And that pharmacies are very eager to, as you know, with aging population, it's harder and harder to find technicians and pharmacists. And so the pharmacist leadership is very clear that they really like those easy-to-use product formulas. So between the temperature storage, we're making big improvements to go to fridge temperature and pre-filled syringe. I think Moderna is going to be very well positioned.
Absolutely. Good improvements there. And speaking of improvements to the original, of course, we can't let you go without talking about the Nobel Prize this week, for the mRNA technology. Really a huge contribution to where you are today and to the technology that you're able to capitalize on. What are your thoughts on this prize?
I think it's a great recognition of the work that those 2 scientists at UPenn achieved. It's indeed, one of the building bricks of the mRNA vaccine and treatments, which is why, we took a license of this patent years ago before going public. So we've always recognized that very significant contribution. The technology requires many more technology pieces, but that's great. I think it's a great scientific achievement that they did to the field. And as you know, mRNA, the way we're building it is a platform. There's never really been platform in the life science space before. This has been, onesies type of product, very analog industry. And so very, very pleased by this recognition by the Nobel Prize Committee for this amazing scientific contribution.
Absolutely. Well, we'll have to leave it there. Stéphane Bancel, Moderna CEO, thanks so much for your time today.
Thank you.
Don't go anywhere. Yahoo Finance Live will be right back.
Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith at the Nasdaq market site. We got just about 7 minutes until the opening bell. Let's see what stocks are doing in pre-market trading. Some relief here, Jared, as we take into account that yields also pulling back from the multi-year highs on the back of that weaker than expected jobs report this morning.
Yes, and I think the bond market giving a little reprieve for stocks is welcome. Here we're seeing the United States markets for the most part bouncing back. That's that green there. I want to direct everybody's attention, though, to the Korean KOSPI index. Over the last 7 days, it is down 6%. This is highly leveraged to the tech sector and can be an early indicator of problems. And I'm just seeing overall a lot of risk-off behavior. First, let me take a look at the sector action. You can see consumer discretionary is up 69 basis points. That's in the lead, followed by utilities, which has also been decimated over the last 7 days. There's that chart. Looks very similar to the KOSPI. And to the bottom, we have energy. Energy is giving back some gains, some recent gains. But I want to take a look inside the indices as I have a minute here and just show you the breakdowns we've been seeing over the last day or two. Here's the S&P 500 over 3 months. And you can see yesterday just finally broke down that support there. The equal weight S&P 500, where every stock gets one vote, that broke down 2 days ago, but nevertheless, it's heading lower. Russell 2000, very similar story. But I want to show you the Nasdaq 100, which is still holding support, and that's because it has those mega cap sectors or mega cap stocks, rather, that have been not hit as hard as everything else. Now I want to turn to volatility. Here's the VIX. We just hit 20 yesterday for the first time in months. And what I'm really laser focused on is the ICE-BofA Move Index. This is like the fear index for the bond market. This has just been screaming higher. And if I show you a year-to-date chart, and I'll put some, I'll make this a line graph so you can see it a little bit easier. You can see it is just poking its head above this negative trend line here. So is this another regime change? Well, we don't know. We don't know what's happening, but we do know that credit markets are tightening. And by the way, this activity in here, when we saw that spike up, that was in March, and that had to do with the internet mini banking crisis that we saw there. Here's the 10-year T-note yield, just down very, very small amount from yesterday, 6 basis points. But it's been putting a lot of pressure on stocks and other markets recently, commodities as well. And I'm going to close here with a look at the Nasdaq, because Apple down about 70 basis points here. Let me show you. I've been tracking this breakdown of Apple here and not looking good.
All right. You mentioned, Jared, Apple, so we're going to get a little bit more into that. Thanks for setting up the conversation. Stay with us for the opening bell, by the way. Don't go anywhere. Pinstripe twins. We got to stick around, stick close to each other.
Oh, look
here.
at that.
Let's take a look at how the tech giant is moving this morning. Apple shares, they are down right now by about 0.7%. Today, KeyBank downgrading the tech giant from overweights to sector weight. Analysts there citing weaker near-term iPhone sales and a muted upgrade cycle as reasons behind the move here. This is particularly interesting in the note that came out this morning as well here. And one of the things that was particularly noted, even as we're kind of taking a look at Apple, and Apple, even if we think about the past 2-3 months and last quarter, this is a company that has flirted and entered into correction territory, which has really caught the attention of a lot of investors on some of that weakness as well here near term.
Yeah, it has. The valuation was one of the reasons here out of the four for this downgrade here from KeyBank, saying that Apple is still trading, despite the pullback that we've seen, still trading at a large premium to the Nasdaq versus historical levels. So yes, we have seen a pullback like you were talking about from the peak levels that we saw during this summer, but still where Apple is traded relative to the Nasdaq, they're still saying it's too large of a premium compared to what we have historically seen from the tech giant. Also, weakness in the U.S. demand, you mentioned that, but slower international growth rates as well. Some questions there about what Apple is going to see demand-wise for its products from around the world. And then also there's the estimate. They view, at least the estimate is full on both the top and bottom line perspectives, lack of a near-term catalyst. There's a lot riding on that new iPhone model, whether or not that was going to be the catalyst, if it was going to be enough to get people off the sidelines and to upgrade their iPhones. Right. It's expensive. It's very expensive. Yes, it has a new camera that some people might get excited about, but judging by at least the initial reaction and some of the commentary that we're seeing from the street, maybe we should be bracing for another quarter-over-quarter decline.
I have a good camera, and you know, I throw that in the bag whenever I travel. Yeah, the phone, and that is essentially what it is, right? You're just carrying around another camera at the end of the day for the people who don't want to go out and purchase a DSLR. However, you'll see the difference. All that said, the international growth is needed here for Apple. That's part of this note. You were mentioning that, but the trends here, they suggest some of the challenges, and particularly KeyBank noting that consensus expects every single international segment to show accelerating year-over-year growth in fiscal year 24 versus fiscal year 23, though they struggle to understand why that will be the case. Well, I would point to one data point, at least here, coming from IDC and their mobile phone tracker, because worldwide smartphone shipments, they're forecasting them to reach their lowest volume in a decade. But iOS, that is expected to take on even more market share. I believe the record level that it could potentially climb to, 19.9% of the global market share. So that particularly is interesting, and that perhaps is one of the data points that would suggest that there is a lot more opportunity international growth-wise for Apple.
Yeah, certainly a name, obviously, that you got to keep on your radar at all times. All right, let's also talk about another tech mover today, and that is Intel. Shares are on the move to the upside. The company saying that it plans to operate its programmable chip unit as a standalone business with plans to spin it off through an IPO within the next 2 to 3 years. You're looking at a gain of just about 2.5% pre-market. Now, Intel is saying that it will continue to support the business and also retain a majority stake. Not necessarily a huge surprise given the fact that Intel has shifted its strategy just a bit in order to focus on its core assets and not so much focus on some of those non-core assets. So this move here, in terms of what the street is saying on this, Brad, TD Cowen saying that this is potentially a prudent move to unlock shareholder value and go on to raise more cash. However, it's unlikely to materially offer the competitive environment of either Intel or any of its peers, at least for now.
Yeah, this is really kind of starting off this wave of individual segment spin-offs into IPOs, companies being able to capitalize on that, considering the amount that they would have or amass in some of those gains once you see that kind of day of pop, and perhaps even more so later there. We're taking a look at the opening bell on Wall Street. My goodness, it's been a week of mascots at the New York Stock Exchange here.
And a lot of excitement.
And excitement over here at the Nasdaq as well. Nuvini ringing the opening bell. We saw them with the blue shirts as we were getting ready. They didn't bring any of that funfetti up here, though. We need to get some of that and just toss it up in the air like LeBron James before a game. Anyway, let's take a look.
Maybe our new pre-show ritual.
That should be, actually.
Yeah,
We're gonna
with
take
music
that.
blasting, we're on to something.
Yeah, social team, get ready for that video coming your way. Let's take a quick look at the markets here. Major averages as of right now. You're seeing them calibrate right now. The Dow, the S&P 500, and the Nasdaq, all of them starting off the day in positive territory. We told him to stand by. He did just that. Jared Blickery, he's over at the Wi-Fi Interactive.
Brad, I've been waiting for the funfetti over here just to come today, and I'm all for that, so let the record reflect. But we're looking at mostly green here in the 11 S&P sectors. Energy, a notable standout. That was also down in the pre-market, down about 1.35%. But what's leading the way is materials. That's up 0.8%, followed by retail, consumer discretionary, then real estate, utilities, staples, and tech. So an interesting mix there, but could be considered just a mild bounce back from the carnage that we've seen lately. Now, here's my leaders index, and what I'm seeing is some of the fringier parts of the market, like meme stocks and IPOs, not getting a lot of love today. So we'll have to see if gains can be forged, how inclusive they're going to be. I've been watching a number of stocks that are making new 52-week lows really accelerate recently, a trend that could be concerning for the intermediate term. Now, let's take a look at the disruption. That's the word I'm looking for. This is arguably a fringier part of the market, but this is seeing some love today. Shopify up 2%, Path up a similar amount. Looking at China, which runs on its own fundamentals, mainly red here, Baidu down 1%. And then just taking a look at energy, where we did see, we have seen crude oil back off of those $95 highs. We got an OPEC Plus meeting in the works today. And here's Exxon down about 2%, Chevron down just a hair under that. And then British Petroleum, BP rather, up 2.25%. Now let's take a look at another value sector. This is a banking sector. Not seeing a lot of outsized winners or losers here, dark green or dark red. And so I'm going to move on to EVs. We've been tracking some of the some of the statistics for the last month over the deliveries that have been made, and we can see Tesla up about 1% today, Toyota Motors down 3.7%, and GM up 0.2%, Ford just off about 1/3%. I'm going to close on the travel trade here to see what's in the sky, and smooth sailing here, sorry for the mixed metaphor, but Delta Airlines up 1 2/3%, Royal Caribbean and Carnival Cruise Line each up more than 1%, guys.
All right, Jared, thanks so much for getting us up to speed on some of the movers that we're seeing this morning.
We'll keep you updated on that funfetti. Also here, some moves in the marijuana sector. Tilray shares, they are on the move. They're in focus this morning after the company reported its Q1 2024 results this morning here. Tilray seeing a 15% increase in net revenue during the quarter, amounting to $177 million. That's up from the $153 million in the previous year's quarter. Also saying their net loss narrowed to $56 million. That's down from $66 million. So you got some improvement there. Just this week, Tilray acquired 8 beer and beverage brands from Anheuser-Busch. Today, Yahoo Finance's very own Julie Hyman talks to Tilray CEO Irwin Simon. That's coming up at 3 p.m. Shares right now down, though, by about 0.5% here.
All right, we are now looking at some of the software stocks this morning. Palantir's co-founder Peter Thiel is set to secure a contract with the UK's National Health Service. Now, the controversial 5-year contract is valued at more than $480 million, and it's meant to enhance the NHS's data analysis capabilities. Many, though, criticize the NHS's association with the analytics company, citing patient data privacy concerns, something that we know has been top of mind and an issue now for some time. But when it comes to Palantir, whether or not that's going to materially move the business, we're seeing some excitement around this with shares up just about 2%. But Brad, Palantir is a company and is a stock that initially at the start of the year was riding a lot of that enthusiasm for AI. Palantir really saying that they are one of the critical players within AI. Over the last month or two, we've seen some on the street come out question just that and how quickly their business could potentially benefit from AI. Morgan Stanley was one of those on the sell side, analyst Keith Weiss coming out saying that stock's valuation fully reflects the AI euphoria, and any tailwind from this trend is going to take some time to materialize. So a deal like this may be offsetting some of those concerns. Year to date, we're still up nearly 140%, but we'll see what this deal does to its business.
Yeah, summer sputter did not diminish some of those major returns that investors had seen. As you were mentioning, 140% roughly year-to-date returns for Palantir, and a company that hinges a lot on some of those major government contracts. Of course, government's trying to figure out where they can deploy some of their own AI research, and then additionally, kind of making sure that that goes into their own defense mechanisms. So many different instances where Palantir already plays as well. So we'll see how they continue to be a near-term beneficiary, perhaps even further long-term as well.
All right, we'll keep right here on Yahoo Finance. We got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Goldman Sachs analysts and top executives from across the technology, media, and telecoms landscape are gathered in San Francisco for its annual Communacopia and Technology Conference.
Nextdoor is doing some pretty cool things on the AI front with our assistant and also with Vitality. For us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you.
There's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment.
I think any creative would admit that AI is transformative to how they think about and how they concept new ideas. So I think it's going to be very exciting. It's still early innings, and we got to figure out how to do it right.
There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created.
There certainly needs to be a lot of debate about AI and journalism. 57% of newsroom jobs in the United States have been lost. We're facing another wave, in this case a tsunami potentially of job losses because of the impact of AI. And these are not just jobs lost, but it's insight lost. It's important that all media companies understand the impact, but it's incumbent on the big AI players to understand their impact.
We launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help.
AI is going to change this whole industry completely. And so we're thinking a lot about how do we use AI to match people a lot better, and to support the conversations that are happening. I think conversational AI is also a big opportunity because people do produce all these messages. So helping them craft those messages, make it easier to communicate, I think is something people will really appreciate as well.
Airbnb coming off its second worst day of the year. Shares fell after KeyBank downgraded the stock to sector weight, also raising some concerns about future margins and revenue. Now, the analyst behind that call, Justin Patterson, KeyBank Capital Markets Managing Director, joining us now. Justin, it's good to see you. So certainly we saw the reaction in the stock yesterday following your downgrade. What are the biggest issues, or I guess why do you see a more tepid outlook for Airbnb at this point?
Yeah, thanks for having me this morning. The downgrade is really based on a couple of different factors. First, we're coming off several years of pent-up travel demand. So as we look at some third-party data, as we look at just the next year, we think both the outlook on room night growth or volume metric and ADR growth, price metric are too high. You actually see Brian Chesky, the CEO, in interviews and down. The second piece of that is just the trickle down in demand. Airbnb's made a lot of margin progress so far. In our view, over-earning a little bit right now, the higher ADR environment. As you go through prices getting lower, the unit economic effect, where you just don't have the same degree of margin as you have. We look at estimates, they look too high for the street, you get valuation at 20 times.
Justin,
too high.
we're just going to come right back after this break. We're going to try and get some audio issues figured out real quick. All right, we'll be right back.
Airbnb coming off its second worst day of the year. Shares fell after KeyBank downgraded the stock to sector weight and raised some questions about future margins and revenue. Now, the analyst behind that call, Justin Patterson, KeyBank Capital Markets Managing Director, joins us now. Justin, it's good to see you. So Airbnb shares under pressure yesterday. The biggest factors, though, for your downgrade, what are they?
Yeah, it's a great question. So we downgraded the stock, like you said, and that's really just predicated on a slowing room night environment. Airbnb is coming off several years of pent-up demand, several years of great supply growth, and a moderating ADR price environment. The CEO, Brian Chesky, has even been talking lately about how pricing needs to come down. If you look at Airbnb relative to hotels, that pricing discount isn't what it used to be. So we think that when you roll that through the model, there's risk to revenue next year, and in turn, you just don't have the same degree of leverage you've had in the past. So we think consensus estimates are too high. The growth premium Airbnb gets versus its closest peer Booking needs to erode a little bit on the multiple, and that just makes for a range-bound stock.
And when you think about the average daily rate, now some of that has come down because of kind of wave of new listings from some of the releases that they've put forward and trying to get added number of hosts, whether that be short-term or long-term. So where has that also kind of played into that average daily rate that we're seeing customers opt into? Because now that you've got more supply, naturally there are different areas, different realms for people to look across their bookings, whether they want to stay in Barbie's dream house or Shrek's house, or whether that's just at, the apartment down the street from here in Times Square.
Right. So there's a lot of moving pieces in there, like you articulated. So paying for Barbie's dream house is going to be a lot more expensive than, say, paying for an apartment in New York. And when you control for those different factors, I'd say about half of that is Airbnb inflicted. So using price optimization tools in North America to bring pricing down. And then half of that is what you would call more apartments versus more whole houses within there. Going forward, we think that a lot more of that is going to be driven by property mix. So the trade down to lower price products, and then to some extent, just moderation from this pent up demand wave coming to an end. We've had a lot of crowding into urban markets, a lot of crowding into Europe. We don't think travel's as strong in the next year, just given how stretched the consumer is.
Joseph, when it comes to some of the ideas that we've heard from CEO Brian Chesky, did a recent interview with the Financial Times talking about some of those longer term stays, how that exactly fits in to their business plan going forward. How big of an opportunity do you potentially see this being for Airbnb in the long term?
It's a great question. It's a new use case that came about during the pandemic. The question mark is always just where exactly does that level off as a percentage of the entire business? Since if you look during the pandemic, this was consistently around 20% of overall room night growth. It's a very big number with people required to go back into the offices these days. It's a lot harder to justify a large number of people being digital nomads, if you will, just traveling the world, living on Airbnb for 30 days, even 90 days at a time. So I think when you look at the core business, it's likely a subset of that, probably sub 10% over time.
Brian Chesky has been kind enough to take some time here with us on Yahoo Finance at a few different occasions over the year. When you think about what from the leadership team that you need to hear in order for there to be an all clear sign that this is a company that can go head to head with some of the capacity that's coming online from the legacy hotel and accommodation space, what would you need them to signal?
It's really what's the next leg right now. So if you look at travel, it's actually one of the sleepier categories in internet. It's consistently been the most penetrated because, booking for a travel agent versus booking online, night and a lot, it's taken a lot of. With Airbnb, you've had a lot of hyper growth the past few years from supply coming on board from the pandemic. But now it's turning into what's the next vector to grow Airbnb? How do you get the new user on there? How do you get more trips versus hotels? And that likely implies, one, just producing better results for the conversion vector using AI to narrow the field. Bookings, that's good on the margin, but it's a slow rate of change. And the other is just layering in non-accommodation activities like experiences. And that's also a very difficult thing to scale. So I think this is more a multi-year transition versus an immediate fix over the next year.
Absolutely. Justin Patterson, KeyBank Capital Markets Managing Director. Justin, thanks for taking the time here to break down your most recent note on Airbnb. We'll continue to track shares as we move on throughout the rest of the session. Appreciate it. Thanks. All your markets action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Welcome back. You're watching Yahoo Finance Live. We are at the Nasdaq market site this morning. Kevin McCarthy is out, though, as Speaker of the House, thanks to a historic vote that saw 8 members of his own party side with House Democrats to oust him. But what is this all about anyway? Hardline Republicans, including Representative Matt Gaetz, who led the drive to out McCarthy, say that they want spending cutbacks and less government debt. Do they have a point? With more on what he's keeping on his radar, we're joined by Rick Newman. So do they have a point, Rick?
They do have a point, but nobody is serious about what to do about this problem. So just to provide the context here, the total U.S. public debt is now $33 trillion. And that is up from $23 trillion just 3 years ago. So we've added $10 trillion in debt. There you can see the depressing chart. We've added $10 trillion in debt just in 3 years. Most of that was COVID stimulus spending. Economists say that was generally the right thing to do. We've had a really strong recovery from COVID in the United States, but nobody is talking about what to do about that debt. So, Matt Gaetz, when he was fulminating in the House yesterday, he went on and on about how Congress just spends money with reckless abandon and so on. But look, he is not pinpointing the way that you actually solve the problem. I mean, you've got Republicans basically saying, let's cut arts funding and these little itty bitty programs that really account for a tiny portion of the budget. The way you have to tackle this problem is you have to figure out what to do about Medicare, Social Security, and Medicaid, which are the main drivers of this debt. And this is only going to get worse in the future. So when you hear everybody in Congress saying we need to do something about this debt, you have to say to them, okay, Medicare, Medicaid, and Social Security are the problem. What's your plan? And by the way, don't tell us we should cut taxes. I mean, you cannot cut taxes if you are serious about the debt. That's exactly what Republicans did in 2017, as we know, with the Tax Cuts and Jobs Act. Matt Gaetz voted for that. He voted to cut taxes. And this is coming up again. At the end of 2025, some of those tax cuts are going to expire, which means we're going to have de facto tax hikes unless Congress does something about that. So that is a big issue that's looming out there, and we need to be having a real conversation about this. Right now, we are not having a serious conversation about this.
Rick, how hopeful should we be that we are going to have a real conversation about it? Yes, we've heard both sides of the aisle address the debt issue, but they both blame each other for what's transpired, what's happened. And I think you make the argument that obviously they're both to blame to some extent.
I'm not hopeful we're going to get serious about this anytime soon. I think it's well understood that it's going to take a crisis, or at least something that is fully recognized as a problem, before anybody ever gets serious about doing this. Both parties are equally guilty here, I think it's fair to say. President Biden, for what it's worth, I mean, he does have a plan. His plan is to raise taxes on businesses and the wealthy. Apparently, that is just not something we can do in the United States anymore. And, I don't let voters off the hook either. Voters, in principle, they're worried about all this debt, but nobody wants to make a sacrifice. Taxes should always go up on somebody else, not on me, no matter how rich you are. No, it's not my fault. It's put it on somebody else. And that's the problem. So we may actually be starting to see the beginning of a real market problem here because, these rising interest rates that we've been talking about for the last month, which are going beyond what the Federal Reserve is doing, one of the causes of that could be that we now have too much U.S. debt in the market. And everybody who used to buy that debt is not buying it so much anymore, including China, perhaps. So rates are going up as a result. That affects mortgage rates, that affects car financing rates, it affects credit card rates. So it's possible that this is finally starting to hit ordinary people, but it's complicated. It's easy to dissemble and put disinformation out and just kind of lie about the whole thing. So we have a ways to go.
All right. Thanks so much, Rick, for keeping tabs on this and, of course, some of the disarray in Washington, D.C. so that we don't have to every day. Appreciate it.
My pleasure. See you guys.
Thanks. All right. Well, keeping things in the Beltway for a hot second here, President Joe Biden canceled $9 billion in student debt. An announcement and a press release from the White House this morning announcing an additional $9 billion in student debt relief for 125,000 Americans. And here's the breakdown here. for the announcement that it has approved $5.2 billion in additional debt relief for 53,000 borrowers under public student loan service forgiveness programs, nearly $2.8 billion in new debt relief for about 51,000 borrowers through fixes to income-driven repayment, and then $1.2 billion for nearly 22,000 borrowers who have a total or permanent disability who have been identified and approved for discharge through a data match with the Social Security Administration here. The inflation conversation that we have every day, part of inflation in America is also a result of the rising costs of college and how that has far outpaced some of the wages that people are able to amass in their careers in some instances for the degree programs that they had entered into and taken on this debt, and then that pushing back the ability for family formation, for the ability to go in and purchase homes. That impacts the housing market as well. So this just has a larger ripple effect that we have to get our hands around.
Yeah, certainly impacting millions and millions of Americans, the ripple effects like you talk about throughout the economy. We know that the Biden administration has made student debt forgiveness a priority here. So finding every way they can in order to offer a little bit more relief to those who are faced with mounting debt here from their time in school, in education. When it comes to just going back to what you were saying, just how this affects so many Americans, there's been a number of studies, a number of surveys just talking about the fact that we do see this resumption of federal student loan payments on October 1st earlier this week, what that is doing to millions of Americans. There was a recent study conducted by the Consumer Financial Protection Bureau estimating that 1 in 5 student loan borrowers could potentially and were expected to struggle with the resumption of payments. So many people are adjusting their spending patterns, delaying some of those bigger purchases, like you said, whether or not that's household formation, whether or not that's buying some of those bigger ticket items, and obviously the ripple effects that that's having across the country. And certainly we need some sort of reform here, right, going forward, getting the cost of college down and making it more affordable for the thousands, millions of people who want to pursue higher education. Absolutely. So something we are going to continue, obviously, to monitor here at Yahoo Finance. All right, keep right here on Yahoo Finance. We've got all your market action ahead live from the Nasdaq market site. We'll be right back. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith, live from the Nasdaq market site in New York City. We're just about 30 minutes into the trading day. Let's take a look at how things are shaping up on the street. Stocks are on the move this morning. We're seeing a bit of a relief when you take a look at the S&P and the Nasdaq. The Dow, though, back in negative territory. Treasury yields paring back some of the recent gains. A sell-off in bonds sent the 30-year yield above 5% earlier in the week, a peak not seen since the 2007 financial crisis. These market moves come as ADP reports growth in private payrolls. That slowed sharply in September, adding 89,000 jobs. We're seeing that as a welcome sign here for the street that was well below the 150,000 expected.
Let's take a look at some individual names here. Cal-Maine Foods falling this morning after missing analyst expectations for the first quarter earnings. The sales, they sunk by about 30% as the price of eggs fell to $1.59 per dozen from $2.28 a year earlier here.
We are also watching Tesla rising today. Morgan Stanley reiterating its overweight rating on the stock. This comes as the EV maker launched a cheaper version of its Model Y SUV for the U.S. Now the new model comes in at just under $44,000. Still, though, Tesla is facing increased pressure from some of the rivals, specifically in China. We got some new numbers out this week. BYD among those that turned in stronger production month than the EV giant Tesla.
And we're watching On Running. The stock slipping today as it hosts an investor day in Zurich, Switzerland. The athletic shoe company laid out its growth plan, saying that it intends to double its expected 2023 net sales by 2026, while increasing its adjusted EBITDA margin to 18% or above that in the same time frame.
All right, now let's get to our market commentary of the day. And it's all about the big tech giant. Shares of Apple moving a bit lower this morning, off just about 0.1%. KeyBank downgrading the stock to sector weight from overweight. Now the analysts that are leading the team, Brandon and Nispel, saying that the stock is trading near all-time highs, while its sales growth is likely slowing. He also went on to write in a note to clients this morning that, quote, U.S. sales are likely to struggle based on our view of U.S. upgrade rates and also initial U.S. iPhone promotions from U.S. carriers being restricted. This, of course, comes after the release of the new iPhone 15. Lots of questions about what exactly demand is going to look like for that brand new iPhone model. But when it comes to some of the other issues that KeyBank raised in this note, they listed 4 factors, among them, obviously, the weakness in U.S. demand that we were just talking about, international growth rates, valuation there. And then, of course, Brad, this begs the question, if we see more of a downside risk here to Apple, what that then tells us, or what that could potentially signal about the broader market, given the role and given the importance of Apple and what it did in terms of the momentum to the upside that we saw at the beginning of the year.
And it didn't even have to do so on the back of a major AI story. Sure, there was part of that in the presentation that took place at September and mid-September, when they typically make a lot of those product announcements, as well as earlier in the year, the inclination for many of the tech giants to be asked or to at least put something out about AI, and then for many of the analysts who were on earnings call after earnings call to ask them about what they were doing with AI. It was not Apple kind of being the driving force or voice behind that move. It was more so being reactive and answering questions, but saying, yeah, that's not the entire story or the entire narrative that we need to hang our hat on here. So I think for what we're seeing right now, it's really more of a construct of where the consumer finds themselves either able or not to opt into one of the higher phones. And that's where typically in the past, many years past, where we would have typically gotten the average selling price that we were able to calculate. We haven't been able to get that for years now. So at this point in time, we're really just kind of relying on the data that comes from Tim Cook as well as Luca, the CFO, and trying to best gauge where the consumer is continuing to gravitate either into the major lion's share driver for this company in the iPhone or some of the other ecosystem products. And this could be an other ecosystem product type of fourth quarter for the calendar year that is key to pay attention to with Apple, whether that be some of the watch devices that they had announced or whether that even be for your ears, the AirPods out there. And so seeing where consumers are still buying into that ecosystem, and then where that props even more stickiness for a company like Apple within the broader Apple operation system. I think that's what some investors are also going to be keeping a close eye on as well.
Yeah, certainly. And even just talking about the pullback that we've seen in Apple stock, right? Since the peak, it's off just about 12%. Over the last 3 months, we're looking at losses of just around 10%. So we certainly have seen weakness, a lot of that being attributed to higher rates, more of the broader economy and broader market, some of the headwinds that are facing not only Apple, but also some of its rivals out there in terms of the larger tech names. But this note here from KeyBank also pointing out some specific issues pertaining particularly to Apple, a lot of that on the back of consumer demand and what exactly that looks like for their products ahead of their very important holiday season. We know it's always an extremely critical time here for Apple.
I know. I got my Apple Watch during the holiday season a couple of years back.
Oh, not a bad present.
Yeah, I know. Seriously. Thanks, Dad. Also, Ford reported its third quarter sales this morning, up 7.7% from a year ago, driven by a jump in truck sales, especially from the Bronco brand. I was particularly excited about that part of the report here because for Ford and how they're trying to make sure that they can continue to be the number one selling truck manufacturer as total truck sales expand in Q3. The Bronco family, that was up 24.8% on sales of 66,120 SUVs. For the Mustang fans out there, all right, I got something for you too. 7th generation Mustang, that hit the streets, first full months of sales, that was up 90% here. And so this is as the company is continuing to try and make sure that they can electrify some of the models that give them or that already have the most brand equity right now. And so in that electrification effort, they also posted their best ever electric vehicle sales in Q3. And they said that was thanks to the Mustang Mach-E and the E-Transit as well.
Yeah, certainly those EV sales, they were up 14.8%, nearly 15% on a year-over-year basis in the third quarter. Sales of just over 20,000, actually pretty close to 21,000 units. Total EV sales, though, in September jumping 65%. And a lot of that, like you were just saying, was on the heels of strong demand for the Mach-E. We know Ford has really focused on the Mach-E as one of the first forays into the EV business, and also just gauging from that the demand that we are likely to see here from some of the other Ford EV models that are upcoming here. Ford also saying that it expects the F-150 Lightning to produce sale increases in the fourth quarter as capacity actions on some of their electric vehicle centers are realized. So certainly not a bad report for Ford, given the troubles that we have seen since the start of the strike. But I think that more begs the question of what these sale numbers are going to look like this month for October if we don't see the strike, if we don't see any sort of resolution for the strike. And then that, of course, can start to impact production, demand, pricing.
Right.
We can talk about it all.
Absolutely.
All right, well, it has almost been 3 weeks since the United Auto Workers Union went on strike against the big three Detroit automakers. Ford announcing that it has made its 7th offer to the union, calling its wage increase a, quote, unprecedented improvement. Now, they're offering temporary employees $21 an hour, a 26% raise. For permanent employees, an increase of more than 20% with an immediate double-digit raise on ratification. Now, they also promise increased job security with product commitments to every U.S. UAW plant, faster wage progression, and an end to the 2-tier wage system. Joining us now with his take on the offer and also where we stand on the strike, we want to bring in Tom Narayan. He is RBC Capital Markets lead equity analyst for Global Autos. Tom, it's good to see you again. So we talked to you quite a number of times over the last several weeks leading up to this strike. Here we are in week 3. What's the impact so far, do you think?
I think it's really too early to tell, right? We've seen it in the inventory data that just came out yesterday for the U.S. Dealer inventories are actually creeped up higher slightly, which you wouldn't expect to see in a work stoppage environment. But it is early, and so far it's only targeted specific plants from the D3, maybe only 20 to 25% of the North American production. So it's really too early to tell. The other cross current that's helping such a strong performance from these OEMs is, we still are in a recovery period, right? Post-pandemic and semiconductor crisis in Russia, Ukraine. So a lot of pent-up demand is there. Our inventory levels are still well below where they used to be. And that's, I think, supporting these sales. So too early to tell on UAW's impact. Again, it's only certain targeted plants thus far. It's only been, 3 weeks or so. But as you pointed out, probably October data is where you'll see a bigger impact.
Tom, at what point does this strike become an issue? At what point does that lead you to reevaluate how you're kind of looking across the big three automakers?
Yeah, I think thus far, yeah, it hasn't really been an impact. I mean, obviously, if we look at 2019, it's the last empirical evidence we had. It lasted 6 weeks. It didn't have that big of an impact, actually. There was a really quick snapback that happened. Certainly, if this thing lasts well over 6 weeks, right, several months, then it starts having some serious implications, political implications. These OEMs definitely have some big implications, but I just don't think that happens. You know, the UAW workers only get paid something like $500 a week in strike pay. There's also political pressure from the administration for this not to last that long. So all indications are this will probably last something similar to the last strike, around 6 weeks. And I think OEMs have really strong balance sheets to weather this. Also, you know, there's so much pent-up demand, more than what we had in 2019. There should be a really quick snapback. But yeah, certainly if this thing lasts for several months, then we probably have to reevaluate things.
Tom, what do you think demand's going to look like if, in fact, we do see this last maybe longer than we had initially anticipated? That, of course, could potentially impact production, vehicles available, which would then impact price. I guess, how material of a movement could we see if this lasts much longer than you and many of forecasters have been expecting?
Yeah, that's really the question that everybody's been asking. You know, a 6 week period really would probably help the OEMs keep pricing elevated. It's probably bad for customers like us, right? But that only lasts for a few weeks, you know. So the pricing impact of a 6 week work stoppage, it would keep things elevated for a limited period. If it's several months, yeah, now pricing stays elevated for perhaps an entire quarter. It keeps the pressure on volumes down. But I mean, look, these OEMs dealt with this, right? We had pandemic, we had semiconductor crisis, shortages is nothing new. If anything, some of the OEMs probably like this, right? Because it means they keep pricing elevated, and that's like really what's giving them record profits. But yeah, the longer this lasts, it's just not good optics. Also, it creates an affordability problem for folks like us. If we can't just afford to buy the car, it doesn't matter how much they'd love to price it, right? So the worst case scenario is if they're forced to drop pricing because retail buyers can't afford the car, and you have production problems because of a longer strike. That's the perfect storm that could hurt them a lot, because then you have both bad pricing and bad volumes. That would be the ultimate problem. But so far, we haven't seen evidence of that.
Well, what do you need to hear from not just the automakers and what they're putting forward to make sure that they're actually going to be able to maintain margins that the street has come to expect for years on a previous partnership or a previous deal that they had with the UAW? And how will that significantly shift your calculus going forward?
Yeah, that's the other big question, is what happens to margins with these labor cost increases? It's interesting. I think there's been some agreement coming in on both sides. They're moving closer to each other. So that's why I don't really think it'll be months and months. But we've done some math on the margin impact. It's actually not as severe as a lot of people think it is. It's maybe 100 to 150 basis point of margin hit because of, let's say, a 30% wage increase, which we think would be the midpoint of where both sides are. But the bigger problem is if price mix falls because of affordability, we're at record level pricing, right? Just try to buy a new car now. If that falls back to, if it's back to 2019 levels, that's like 400 basis points. So that's like 4 times what UAW wage increase would do, right? It probably won't be that severe, but if I look at my peer group, other folks like me and their estimates, we're not factoring in any of this. That's the scary part, is estimates probably need to come down. Now, the buy side, the investor community, you could see where the stocks are. They're already pricing in, I think, like a 20 to 30% reduction in numbers. So, you know, maybe the stocks are fairly valued from the buy side perspective, but my peer group definitely needs to take their numbers down.
So, Tom, with all that said, we've long talked about how Tesla could potentially be a winner in all of this as the strike goes on for some amount of time. Now, we just got production and delivery numbers out from Tesla earlier this week. Despite the drop that we saw, they still reiterated their full year volume target of 1.8 million. Seems like a tough task given the amount of cars, the number of cars they need to deliver here in the fourth quarter. Do you think that's still realistic at this point?
Yeah, I think it is realistic, but I think more than anything, I think folks pay a little too much attention to the Tesla delivery numbers. The reality is, I'm sure you've noticed this, there's been a kind of a pivot that this company is made from just selling a bunch of cars to now trying to be a supplier of sorts, right? Charging infrastructure, power electronics, batteries, and then of course, FSD, right? That's like the big thing. That's like 90% of our valuation for Tesla. So look, I get it. It catches a lot of attention. People are focused on it. I still think they could hit the 1.7 million, but I think what it showcases is this is no longer really a car company. It's really an autonomy company, and it's really pivoting to become a supplier to other OEMs, like we saw with charging infrastructure. Quite honestly, you make a lot more money selling software than selling cars.
You can tell by that a lot of people agree with you, given Tesla's valuation right now. Tom Narayan, always great to get your insight. RBC Capital Markets lead equity analyst for Global Autos. Thanks, Tom. Well, we got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Bond yields are backing off multi-decade highs today, but the sizable rally since the last Fed meeting is still reverberating through the markets, and the MOVE index, which is the fear gauge for the bond market, just jumped to the highest level since May in the wake of regional bank troubles. Yahoo Finance's Jared Blicker, he's here to break it all down for us. Jared, take it away.
Thank you, Brad. I'm taking a look at the Wi-Fi Interactive here. This is going to be a 3-month chart of the MOVE index. You're going to notice it just jumped up to the highest levels that we've seen in that time period. And you mentioned it's the highest level since May. That was when troubles from the banking panic in March were winding down. So here we can see just about meeting that level there. But what's noticeable is that on a short-term basis, we are making higher highs and higher lows, and perhaps we are entering into a higher volatility regime. We can't talk about bond market volatility without looking at the bond market as well. Here's the 10-year T-note yield year to date. It's only off about 3 basis points from what are 15-year highs, 4.77%. I'm looking at seasonality in the bond market and also in the VIX as well. The VIX is a fear market of the equity index, and I'm going to tie all of this together because the VIX has been heading higher as well. I have had a target of October 12th based on history as a high in the VIX. So we'll have to see if that comes to pass, but that's what's been happening so far. And this year, seasonality plays in general in the equity indices and the VIX have been working very well since So that's why I'm paying such close attention to this. Now, sometimes when we get to kind of the round numbers when it comes to bond market, like let's say the 10-year, 4.75%, sometimes that will fulfill a psychological target and we'll see a back off of that. And if that were to happen, we'd probably see the US dollar index rolling over as well. The US dollar, a strong US dollar, has been a hindrance to a lot of stocks, and that's a year to date. Here's a look at the 3-month. This looks virtually the same as the 10-year chart. So these two in lockstep have been giving equities a tough time here. If they do roll over, that should mean that equities have the green light here. So maybe that happens after October 12th. Maybe it's not exactly correct, but I do happen to think that we have a little bit of downside before we get that resolution to the upside here. Finally, here's a sector map of what's going on today. Energy down 3%, but for the most part, kind of a ho-hum day in the indices, guys.
All right, Jared, thanks for that. Let's talk about some of the movement that we're seeing in oil. A crude awakening for the oil market. Saudi Arabia and Russia both announcing that they're sticking with supply cuts through the end of the year, which would amount to more than 1 million barrels a day. Now, crude oil retreating just a bit this session. You're looking at a drop of about 3%, but still above $86 a barrel. JP Morgan saying that demand destruction has begun. Let's talk about all this. We want to bring in Claudio Galimberti, Rystad Energy Senior Vice President and Head of Americas Research. Claudio, it's good to see you. So JP Morgan at least saying that demand destruction has begun. Are you seeing that? Claudio, do you have to unmute maybe? We're having some audio issues.
Very sorry for
there we go.
This
we got you now. Go ahead.
Yeah, here we go. Excellent. So I would say that it's a little bit of a strong statement there to say that oil demand destruction have begun. I would say that we are seeing very strong oil demand in the first half of the year, much stronger than people were thinking. And in the second half, we still see oil demand growing around 2 million barrels per day. Now, there is something to be said about the impact of electric vehicle. We begin to see some effect there, but we are very early in the journey for what I would say oil demand destruction. So I say that we still see strong oil demand growth this year and next year.
Okay, and so all this considered, how is this going to, by that time, kind of play out from your estimation and kind of make a broader market kind of move, or is there any kind of overhang even more so?
Well, what I would say right now, the market is very much dependent on the OPEC decision. So I remember coming to your broadcast here about 3-4 months ago, claiming that we were at the beginning of an oil bull, driven by the OPEC decision to make this very, very sizable cuts, 3 million barrels if you put it all together with OPEC, Saudi Arabia voluntary cut, and Russia. We are still in that phase because OPEC decided to basically extend the cut through the end of the year. Probably the reason why we are not seeing a further upside on the price is that all this information is now fully priced in. So everybody expects that this cut to be extended through the end of the year. There is an expectation also that Saudi Arabia may extend the voluntary cut further into 2024. This is very important. And the reason for that is that it is true that oil demand keeps on growing, but the growth we have seen this year is not going to be replicated next year. So if anything, next year we would go to an oil demand growth of, let's say, 1.2 million barrels per day, still very sizable, but consider this year we are growing at 2.4. So if we are going to see markets that are still tight, so basically at the end of the day, inventories that shrink, then OPEC will need to extend its cuts into the first quarter of 2024. And that is yet to be announced. So that is probably the reason why we are seeing the market correcting downwards right now. More so, I would say, than oil demand destruction.
So, Claudia, more specifically on price, I think a lot of Americans are trying to figure out exactly what the price of crude could potentially look like next year, given the fact that there are so many factors like you laid out, a lot of uncertainty still just in terms of OPEC's next move and also what the demand picture is going to look like. How are you factoring China into the equation and the demand, or maybe the lack thereof, in terms of the slower than expected recovery, how that's playing out in the oil markets?
Excellent question, but let's put things straight when it comes to oil demand from China. So we have seen very bearish news when it comes to the macroeconomic environment in China. I do not doubt about that. Specifically, if you look at the real estate sector, China's economy is not doing particularly well. But if I look at oil demand, we have seen extraordinary growth from China in the first half of this year and through now, pretty much through September. So we need to be careful at putting these things basically together. What I say is that for next year, we cannot expect China to grow as strongly as it has this year for obvious reasons. But we are still going to see growth in 2024. So there are many factors to take into consideration. There's also growth in gasoline demand in the United States, which was a little bit surprising to see that this year. But overall, the two major factors here at play is the fact that in 2024, the oil demand growth will slow down. And as a result of that, if we are going to see oil prices close to $100 per barrel, then OPEC will most likely need to extend its cuts. OPEC is actually right now in a gathering, but they are not making any decision. Decision to extend cuts will be made towards the end of November. So this is where we need to put we need to focus on. This is the time frame we need to focus on. Between now and then, most likely we will see oil prices trading waters around $85 to $90 per barrel, I would say. And the reason is that most of this information is now priced in.
Claudio, just lastly, while we have you, how long do you believe that oil prices present a risk to inflation that the Fed must also consider?
Another excellent question. We need to consider the fact that $100 per barrel today is different from $100 per barrel 10 years ago for obvious reason, the rate of inflation. So it's lower. So $100 per barrel today is lower than it would have been 10 years ago when we had the Arab Spring and oil prices were consistently above $100 per barrel back then. Right now, the rate of inflation has come off. There was clearly a component in 2022 and 2023 of rising inflation driven by the rising cost of energy, and oil was part of it. The situation in the United States is better than specifically in Europe. So I would say that with oil prices around $80, $90 per barrel, I do not see this as a problem in terms of inflation. But if we were to see 110, 120, then the rate of inflation could jump back up, and that could represent a problem for the Federal Reserve. So right now, with this level, I would say that the situation is not that bad.
Claudio Galimberti, who is the Rystad Energy Senior Vice President and Head of Americas Research. Claudio, great to have you here with us this morning. Appreciate it.
Thank you very much. Thank you.
Certainly. Well, consumers are feeling the squeeze of orange juice prices. OJ prices hovering this morning at some levels around, $343.95. So that's up by about 0.5% here. And that's after hitting a record closing high last week. Yahoo Finance's Brooke DePalma has more on this story and the prices of OJ. Brooke.
Good morning, Brad. That's right. More food price fluctuation for Americans, for consumers to follow along. Today, we're looking at taking a closer look, at the price of orange juice. Now, those higher futures are being driven by a lower domestic supply coming from Florida, and many experts saying that they don't expect those prices to drop anytime soon. Now, as you can see here, Florida crop is expected to be 713,000 tons. Now, that seems like a lot, but that's actually the lowest since the 1936-1937 season. So a long time ago. And when you think about what exactly is impacting the Florida crop, well, last year we got Hurricane Irma as well as Hurricane Irene. We also had a freeze last January. And in addition to that, we're also seeing a bacterial disease known as citrus greening being spread by insects that's ultimately harming the orange orchards, and now also impacting other major producers as well. We're seeing a similar impact from citrus screening in Mexico. That is the world's third largest orange juice producer. Orange is intended to make orange juice. They had a dry season, as well as Brazil, the world's largest orange producer. They also are being impacted by citrus screening. And this is a major problem considering the fact that Brazil produces about 80% of oranges intended to make orange juice. And one expert telling me basically 4 of every 5 cups consumed comes from Brazil. They don't believe they can recover until the next couple of years. Next year is still going to be low. And ultimately, unlike we saw with eggs, where producers were able to kill off their flock and then rebuild it, this is a bit more complicated. It takes longer for producers to rebuild their orchards. And so really, when you think about what exactly is going to happen here and some solutions that producers are coming up with, they're looking at fumigation. They're looking at planting different varieties that perhaps won't be impacted by this disease, as well as gene editing. But ultimately, at the end of the day, the power is in consumers' hands. One expert tells me that eventually this is going to impact demand. And when demand is going down, that's going to put pressure on prices to go down as well. But orange juice is one of those American breakfast staples. And so the demand right now is still there.
Costing Americans even more. All right, Brooke DePalma, thanks. Let's get to the latest down in D.C. The House voted to remove Kevin McCarthy as Speaker in a historic vote. Now, Congressman Patrick McHenry, a Republican from North Carolina, will serve as acting Speaker for the time being. But Republicans do not have a clear pick as successor. For more on that, we want to bring in James Carville. He is a political strategist and host of the Politics War Room podcast. James, it's great to see you here. So I guess just your reaction to really what's played out over the last several days, ending with the vote that we got yesterday in the ouster and the fact that McCarthy was ousted.
You know, so many times my phone rings and the first thing I hear somebody say, "Can you believe this blank?" All right. And the truth is, I've just come to the point where I'll believe anything I see that comes out of Washington, including the events of yesterday. It's pretty remarkable, and when you view it in the historical context, it's even more remarkable. I mean, when you were watching it, you were saying, "That just can't be happening." And then when you actually read some of the commentary on it, it's more unbelievable than when you're watching it.
James, at what point do you believe that we are going to see some type of normalcy, whatever new normalcy looks like in Washington? When do you believe that will resume? What will it take? And will that address issues, especially economic issues, that Americans are putting upon both parties to try and come to common sense solutions around?
Well, first of all, I don't know, what happened yesterday was anything but common sense. And we've always had political parties and ideological differences, but the question is, when do we stop this descent? I wish I had a better idea. I suspect that the younger generation has a more positive view of pluralism in America than the older generation does. But it's a good question, and I can't answer it. And honestly, I don't think anybody else can. We can only hope.
James, what do you think this really tells us? The fact that the House is leaderless, the fact that it was done because of a small fraction within the party, the far right being able to do this, what it really tells us just about the direction of the GOP and what we can expect to play out over the next 13 months until the 2024 election?
Well, one of the things we always told that elections have consequences. Elections that have a narrow win really have consequences. And remember, the Democrats had the same majority, +4, that McCarthy had. And because of Pelosi's skill and just Democrats wanting to come together, we had nothing like these kinds of issues. And I think most of the stuff that's there now, they raised money off of the cell phone and they sent out blast requests. And Matt Gaetz probably had his biggest fundraising day. He doesn't care. Yeah, it's how much you can be on social media, how much you can raise online. And we're trying to run a government where people are not terrorized by bad stories about them, anything that terrorized by their cell phones and how people are going to respond to it. And that's how this stuff ends up.
Yeah, just as long as he's not doing that fundraising through Venmo. All the things considered here that we have to look forward to over the next year, where do you believe that in all of the conversation in and around Washington, Capitol Hill, where that will continue to move business leaders to want to place their own interests as well? Because that's one of the more kind of weighty parts of this that we continue to evaluate on a day in, day out basis, the business leaders that are looking for some type of answers.
Yeah, I say this in all sincerity. Everybody knows I'm a partisan Democrat. The only hope, if you're a business leader and listen to this, the only hope there is for this country is the Democratic Party. You may not like that, you may not like things about it, or you may say that they're conflicted or anything you want. But given the current makeup of the Republican electorate, there's only one party in this country that even is remotely possible of producing sanity. And I really mean that. Being it as a partisan, but if you look at where they are, the composition of the voters and the people that make up the respective political parties, if you're a business leader or you're somebody that sees country kind of moving forward together and that kind of stuff, that's the only hope you have. I'm sorry. Sorry to bring the bad news to you.
James, let's talk about what the Biden administration, what President Biden, the re-election campaign is focusing on, because we certainly have seen this shift in his narrative, or I should really say how he's framing the fight against inflation, where the economy stands. They were out with a new ad this week talking about the view on the economy, trying to highlight some of the things that have been accomplished within the administration. What do you, just given your years and years of experience, think of this strategy and whether or not it's enough to really move the needle, given the fact that so many Americans still blame the Biden administration, whether they should or not, for the fact that prices are so high and the economy is where it is today?
It's always the argument. So you said people are not giving us credit for the economy, but look at what Paul Krugman says, or look at what the Bureau of Labor Statistics says. Well, look at what anybody else says. So the only way we can get credit is to take credit. But then somebody says, but yeah, if you take credit and you tell people the economy is good and they think it's not, then they have a backlash against you. I think they had to try to put in context the economic achievements they had, but it's so far it's proven to be a terribly hard sell. And the events of yesterday were 100% the fault generated by the Republican Party. But I do have I think it adds to people's sense that it just looks like everything is just going haywire in the country. And this might add to that sense too. But I don't blame them. They got to try to take credit. Got to be doing better than they're doing now. They're pretty sure they're pretty aware of that.
Right. That was one of the criticisms, was that Democrats were not doing enough in previous administrations to market some of their wins to the American public as well. So we'll see how this effort is received, especially going into 2024. James Carville, political strategist and host of the Politics War Room podcast. Thanks so much for taking the time here today. You had the LSU hat last time. You got the Tulane University hat this time.
I got Tulane School of Public Health. Friends there, and I've done some stuff, and they do a very good job, by the way. Very good. Oh, they do.
All right. Thank you. A lot of focus on making sure we were doing the right thing in public health as well here. James, thanks for taking the time here today. All right, we'll let you go. All markets action ahead, live from the Nasdaq market side. Stay tuned. You're watching Yahoo Finance.
All right, welcome back to Yahoo Finance. Lots going on in the world of consumer land in the United States, but also overseas, really where the Chinese consumer continues to struggle a little bit with a slowing economy. Let's dive into a little bit of that, a little bit of what's happening in the U.S. with Mammoth Holdings CEO Dave Hoffman. Good to see you.
Yeah, thanks for having me again.
Let's start in the U.S. here. Mammoth Holdings, an up-and-comer in the car wash business. I call them robo-washes, but these, Dave, as you know, are franchisee-owned small business operators. Yeah. What are these companies up against right now in this economy?
Yeah, and just for those that don't know much about Mammoth Holdings, we're a pure play on express car wash tunnels. We've got 120 today. We'll be somewhere around 140, 150 by year end, so that's a 70% growth rate.
Called Express. I'm the robo
Express,
guy.
yes,
Okay,
Express. So that's 70% growth since I last saw you. And look, the industry is going through consolidation. It's a highly fragmented industry, and so we're one of those players in that space. I feel really good about the platform we're building. I think we arguably have the best platform in the industry. We've got a great management team that is public company ready, and we've got one of the strongest balance sheets. So even though it's a challenging environment right now, we think we're well positioned to continue to consolidate. And I think what makes us different than everybody else and plays to my franchise experience is the owners that we have acquired, and we've acquired 30 brands, we keep them in the company. And so we get all that institutional knowledge, small business knowledge to help us build a great company here.
When you're out there and looking for these acquisitions of these small business owners, in some cases, these are owners that have operated these car washes for years. Do they say, you know what, we're tired of dealing with inflation. We can't find workers to clean these cars. Just take our business? Is that the challenges they're up against?
No, I think what Mammoth provides is sort of a longer off-ramp to retirement, right? And so they want to take some financial chips off the table, some of the risk off the table, but they still want to be part of the industry and grow a great company. And so that's why they tend to choose us, and because we want to leverage their great experience and keep all that institutional knowledge in-house.
Do you see from your perch inflation peaking, or the price of my car wash might double within 2 years?
You know what? We've held prices stable right now. And so, look, everything that we're focused on, I think what makes us and car washing resilient is the subscription model, which is unlimited club. So unlimited wash if you join the club.
I need to join. I spent $45 to get my car wash last week. It's a wallet buster, Dave.
Yeah. We're not, our top price on the top package is $35, but
okay, I can do
so
that.
$20 for the lower package on the unlimited wash club. And so it's resilient in this environment, and it's the car is arguably the number one or number two asset in the household, and people want to take care of it. So we like to view ourselves as the car wash for car people.
We're a couple days removed from a jobs report. It might show a little bit slowing. Does the local car wash still have problems finding employees they need to vacuum a car, to clean a car, and then ultimately to send it back out onto the road?
Well, the labor model is obviously challenging across all industries, food and beverage, my former industry as well. But I think what I loved about this is, yes, you still have to build culture and take care of people, but the express tunnel can run on 2 people during low volume, 4 during high. So it's a highly efficient, you trade labor for capital. It's more capital intensive, but you trade that for the variable of labor. So it's a really good labor model within this environment, but that doesn't mean that you still don't have to invest in, hiring practices, quality culture, all those kinds of things to make you a great operator.
Is there consolidation about to happen in this space? Because the way I look at it, I look at retail, it's a Walmart, it's a Target, it's a Costco. Where are the big national chains in here, and do you see a roll-up situation happening?
Yeah, and it's already in play. I think not only are the consolidators like us buying smaller independent owners, but I think you're going to start seeing more mergers of equal. But there's also financial sponsors, as you and I talked about before. We've built an IPO-ready company, and there's strategic investors looking at this space as well. So anybody that's got maybe outside looking in that has their revenue stream tied to petroleum and gas, they're looking at this industry to diversify. So there's a lot of different options, and I think my role as CEO is to provide my equity holders and investors options to pursue growth capital. But I think you're going to see more and more roll up in this industry.
Now, sounds like you're a busy guy. What made you take this Yum China role? Board, right?
Yes, board role. Yeah, and it was just too compelling. I wanted to bring my 30 years of food and beverage, being an operator.
Thanks for bringing cold brew to Dunkin'. Former CEO of Dunkin' Brands.
Yes, that's right. Okay, yeah. And take all of that operator knowledge, scaling Western brands across global markets. And, I lived over in Asia for over 10 years. So the idea that I could go to Yum China and partner with Joey Watt, who we need to have on. She's a phenomenal CEO. She's a really talented leader, and so Yum China's on the move. I was over there for a week and a half, and got a really good chance to see what was going on there since 2016, when I haven't been back there since then.
One of the biggest challenges that I deal with is getting U.S. investors to care about what's happening in China. They're only focused on 7 stocks, the magnificent 7, these tech stocks. But talk to us about some of the challenges the Chinese consumer is up against and why U.S. investors do need to care.
Yeah, well, look, I think the first thing is you got to take a step back and remember that their COVID recovery started about a year ago, so the end of last year. So they're less than a year into the recovery, and they had a significant spike in April, May of this year as well. What I saw during my trip there versus 2016 is before COVID, it was a consumption upgrade, meaning more of the Chinese consumer spending disposable income on higher ticket items. Today, what I saw, and I think this is natural for the environment that they're in, maybe a little bit of uncertainty, is more of a consumption downgrade. Not less frequency of purchases, but a more discerning customer seeking out value for money. And this plays right into the hands of Yum China. They're a winner on value for money, very accessible to the brand. They have a absurdly large number of loyalty members, 450 million. So they're
450 million.
450 million loyalty members, right? Which almost matches the middle class. Which is, again, what makes this so compelling is the white space that's still available out there, even with that growing middle class.
So much tech innovation usually happens, at least I'll say, let's focus on the restaurant space in China and then finds its way here in the US. I look at what Chipotle came out this week with a machine that might make burritos. Does something like this exist in a Yum China, and should it exist as a way to cut labor costs?
Yeah, I think there's a few things that are going on over there that I think will boomerang back here. The first is, as you and I were talking about on the break here, was, and probably for a future conversation, was the smart restaurant. What I see them doing right now on my first visit out there around an AI integrated smart restaurant, I think is going to be really compelling.
So I walk in there, there's no employees?
Not no employees, but it's just a more efficient run model for how you operate the restaurant, how you adhere to procedures, how do you make sure you're staffed appropriately and delivering a great customer experience. So all of that, inventory, everything is just kind of smoothed out. It makes it easier for the site manager to do less of the back of the house and the admin work and more being able to serve the customer on the front end. So again, a well-run, well-managed, very much more profitable restaurant going forward. I think that whole concept is going to also boomerang, and I think there's things that we're doing here in the U.S. as well. The second thing I saw was just this whole, this adoption of a frictionless retail experience. I know that's nothing new, but things like same-day delivery are not a surcharge or premium like here in the U.S. That's an expectation. Speed of delivery is at lightning fast pace. But
I just spent $8 on my Grubhub order.
Yeah, right.
For delivery.
Yeah, or if you order from the local, Thai restaurant, it might take 90 minutes, around your house. But everything here is 30 minutes or less. KFC's like 20 minutes, Pizza Hut's 25 minutes over there. But I think the thing that really impressed me was grab and go, right? This idea that, again, nothing particularly new, but the adoption that's going on with grab and go. I sat in a KFC all morning just watching hundreds of orders go out. No lines, no POS, no kiosk, people just ordering through mobile, picking up and going on their way to their business. Yeah.
Is the workerless restaurant, is that the future? I look at what Sweetgreen is doing. They essentially want to turn all of their restaurants into machines.
Yeah, I don't know if it's a workerless restaurant as much as how do you get the labor, that variable component of labor, away from some of the less customer serving aspects of the restaurant and more customer focused or more speed of delivery, right? So again, there wasn't anything around POS or at the register interaction or kiosk, but there was a lot more throughput on getting the orders out quicker, which is what their business model is all about. It's great speed of service.
Good to see you in both those positions. And again, thank you for getting cold brew to Dunkin' Brands. I appreciate it, Dave Hoffman, Mammoth Holdings CEO. Always good to spend some time with you. Appreciate it.
Yeah, thanks for having me.
All right, guys, much more ahead on Yahoo Finance. Do stick around.
Don't want to talk to the post office? Uber is giving you a new way to ship your packages. The new Return a Package feature will allow users to send out up to 5 packages at once through their Uber driver, who will pick up the packages and drop them off at UPS, FedEx, or USPS. Yeah, I think I would opt into this pretty quickly. I mean, I guess the specs around this too. I guess you have to make sure that it's ready to ship, which is usually my issue. But again, this at least takes out some of the friction of having to go in person yourself.
Yeah, I think that this is smart by Uber, right? It seems like a relatively light lift for them. Another way just to further diversify their revenue stream and grow their business, make it more of a one-stop shop for everything regarding transportation, whether that's taking you somewhere, whether that's delivering your food, whether that's returning the packages for you and transporting them to USPS, UPS, or FedEx. It is, though, similar. These types of offerings are available, obviously, for those 3, for USPS, for FedEx, and also for UPS, but also for DoorDash. So this is Uber just becoming the latest player within this space. And what it costs, like you said, $5 for pickup. I think it's only $3 if you're a member. It's not too bad. It's very convenient. And we know that people throughout the pandemic have become very reliant on delivery services, on convenience. They want everything at their fingertips.
Oh, yeah.
I would think that this would play very well with those that already use Uber.
Yeah, indeed. I think this is just another revenue driving opportunity for them as they try to create more of that ecosystem around the Uber app as it is right now, whether it's food, whether that's mobility, either for yourself or for your packages. This is one additional add-on to that.
So it sounds like we both give it an A.
I'd give it an A. I'd give it a try.
All right.
Yeah.
I think it'll be interesting to see how they grow this business. All right, guys, well, that does it for us today. I'm Brad Smith, or I'm Shauna Smith for Brad Smith. We've got Rochelle Agufo and Akiko Fujita taking you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita along with Rochelle Agufo. Here's what we're watching at this hour. House Speaker Kevin McCarthy is out. So what happens now? The chaos in Washington continues, and we've got an exclusive conversation with Senator Elizabeth Warren this hour.
And long-term Treasury yields paring back gains this morning after hitting the highest level since 2007. What this means for the broader markets.
Plus, strikes are expanding to healthcare. 75,000 workers at Kaiser Permanente have walked out of offices and hospitals over a staffing dispute. We're going to break down what this means for the sector up ahead.
That's right. But first, let's take a look at how the markets are faring an hour and a half into the trading day. Still seeing a mixed picture here. The Dow currently off about 120 points, or about 1/3%. The S&P 500, they're also down ever so slightly, though, about 7 points. Tech-heavy Nasdaq, they're the only one in the green right now, up about 1/3%, or about 40 points there, on some of that softer than expected ADP jobs data coming out this morning. Let's also check in on the Treasury market, as we're seeing a little bit of a pullback this morning, but still hovering near 2007 highs. But as we can see, the shorter 5-year yield down about 0.5%. The 10-year also in similar territory, down about 0.5%. And similar situation there for the 30-year longer term yields there, down about 0.67%. Well, the U.S. is on the hunt for a new speaker after Representative McCarthy was ousted in a historic vote on Tuesday evening. Steve Scalise of Louisiana and Jim Jordan of Ohio are currently the leading contenders. I mean, we have quite a few names in the hat here. Obviously, we have the temporary House Speaker for the moment in terms of Patrick McHenry. Now, he was also one of the ones who was one of the negotiators who helped negotiate the debt ceiling. So people could be wondering, is this going to be more of the same if they back McHenry here? So as we try and navigate this space, a lot of people wondering, does this increase the likelihood of a government shutdown if we do have a House in disarray? Or perhaps this is happening early enough that perhaps they might be able to get a contender and have perhaps a clear voice when they do head towards that November 17th deadline.
Yeah, Rochelle, I mean, as of now, we're not expecting a lot of movement going into next week. Tuesday is the day we're looking at in terms of the next marker here for Republicans to potentially meet behind closed doors, maybe decide on who they want to put forward as the next House Speaker, and then a potential vote coming up on Wednesday. But really, there is need for some expediency because of that very point you made, Rochelle. You know, from a market's perspective, it really is about the November 17th deadline we're looking at right now. Remember, everything that preceded Kevin McCarthy being ousted was about that stopgap measure that would allow the government to continue being funded through November 17th. The longer this takes in terms of deciding on who that next House Speaker is, that means essentially that the House is unlikely to take additional action on bills to fund the government. And that's the key question here is, will they be able to get to that November 17th deadline to have a longer term funding bill in place there? But right now, things very much up in the air.
It's true. And I mean, one of the names being thrown around, former President Donald Trump. We've seen that Marjorie Taylor Greene, Troy Nehls, they're also saying that they're supporting Trump. Though interesting that Troy Nehls, he didn't vote to oust McCarthy. So something of the allegiances here coming into play. But you don't have to be a member of Congress to take the speaker seat. But this would be the first time, if this is a name that ends up coming forward, that someone who wasn't a member of Congress took the speaker seat. And as we mentioned there, it raises the threat of a shutdown, but also speaks to governance and how much consistency we can expect. If Trump now comes into the fray, obviously a lot of people expecting the harder right members of the GOP to get some of their policies pushed through, which will essentially be dead on arrival for Democrats here.
Well, and we should point out the former president has said he's not really interested in taking on that. He's got a bigger eye here on the prize in terms of becoming or for the 2024 election. But, you know, we're learning a lot about the Constitution, right? As we look through what has been a historic 24 hours or so. We should point out our very own Jen Schomburger has been speaking with Senator Elizabeth Warren, an exclusive conversation that's coming up at 11:15 a.m. Eastern. Certainly going to be interesting to hear what she has to say about what's playing out right now on the Hill. Well, let's turn our attention back to the markets now, with Treasury yields pulling back just a bit from multi-decade highs, but the 10-year still there, hovering above that 4.7% level. Of course, we are looking at peaks we haven't seen since the 2007 financial crisis. The 30-year yield briefly traded above the 5% level right now at 4.9% right now. This sell-off in bonds triggered by the bet that interest rates will remain higher for longer, given the resilience in the U.S. economy. Now, private payroll data from ADP this morning pointed to a sharp slowing in hiring for September. Investors will be looking to Friday's jobs report for more signs of cooling. Let's bring in Dana D'Auria, Investnet Co-Chief Investment Officer. I'm good to talk to you today. So we have seen a bit of a pullback here in yields. Certainly that story far from over, given the ADP data that we got today. What do we glean from it in terms of what we could get on Friday?
Yeah, well, it does seem that we're getting some mixed signals on employment, I would say, right? I mean, employment has obviously bolstered this economy for a long period of time now, empowered the Fed to raise rates. And when the Fed talks about, hey, we're looking very closely at the data, employment is clearly, kind of top of the list. But some mixed messages, right? The ADP report, the JOLTS report. I think what you take, the high level takeaway is that, yeah, we are starting to see some cracks in the labor market. You're starting to hear financials, layoffs in the financial sector that maybe had been held off to a certain extent. But overall, the labor market still hasn't shown the kind of cracks that I think would prevent the Fed from looking at another rate hike. And, that's where the market's worried. I think we're in this period again where good news is actually bad news because the market assumes then it means another rate hike is coming.
And Dana, we've seen some of this bond strength, the domino effects in some of these other markets, including Germany's market as well. But I want to ask you, in terms of how this is informing what's happening with equity markets and corporate bonds, what sort of spillover effect can we expect here?
I think it's been a little bit, surprising. I mean, coming from the perspective of, retail advisors and clients and owning, public market equities and bonds and this tried and true kind of formula where the bonds will diversify the equities and act as ballast. And of course, we're seeing once again that that's not necessarily the case, right? But I think the interesting thing is that when there's turmoil in bond markets, it absolutely can spill over into equity markets. So that hoped for, negative correlation is not there. I think bonds, if it's an equity market problem, bonds, maybe more likely to, be that buffer that folks are looking for. But the turmoil is coming from the bond market. I just don't think that it's that surprising. We've had a year of the equity market saying everything's great, soft landing. And now the equity market is starting to price in, well, maybe not. Maybe, economists keep kind of pushing forward this expected recession. Maybe it's coming. I don't think it's surprising at all that we're seeing the bond market start to price in both the effects of, okay, well, it looks like growth is somewhat on track, but also possibly just this higher for longer, right? And taking the Fed at its word.
Yeah, I mean, Dana, I have to say that the market reaction has been really interesting to me because when you think about the messaging coming from the Fed, it's been pretty consistent. And now it feels like investors are finally taking to heart what the Fed has been saying for quite a while now. Looking specifically, though, at the yields right now, you've got the likes of Bill Gross saying the 10-year yield is going to hit 5%. Not going out on a limb when you consider where it is right now, but is that kind of where your assumption is? Is that where you're basing your investments off of right now?
I don't think 5 is, so outlandish. And it wasn't long ago that it appeared that it would be. But, look to the yield curve inversion. Look to where 2 years are, right? Are we not expecting at some point that, we get back to a normal relationship there? When you look at where inflation is, when you look at where Fed funds is, you have to have some expectation of normalization. So which way is that going to go, right? And, you can say, well, no, I don't expect longer dated bond yields to increase. Then I must be expecting that the Fed's going to cut, right? And this is the whole pivot argument. There's definitely disagreement on that point, right? How much we're going to get in the way of cuts next year, I see, we're going to get 200 basis points of cuts to don't expect much in the way of cuts at all, right? We just saw the dot plot move pretty significantly the other way on that. So I don't think it's surprising, what's transpiring. I do, largely speaking, still reflect caution in how I talk with investors and advisors, because at the end of the day, if it works out great, that's nice. But the historical record doesn't suggest that you're likely to have no pain after a tightening cycle like we just had.
I appreciate you joining us with your insights, Dana D'Auria, Investnet Co-Chief Investment Officer. Thank you so much.
Thank you.
Right, well, we're watching shares of Amazon this morning moving higher today. According to a Wall Street Journal report, the tech giant used an algorithm codenamed Project Nessie to raise prices. Now, this was found in redacted portions of the Federal Trade Commission's lawsuit against the company. Now, the algorithm reportedly allowed Amazon to boost profits by raising prices in a way that competitors would often follow. Nessie was also reportedly used to match discounted prices from competitors like Target, and other competitors would follow, lowering their prices. Now, when the competitor's sale ended, Amazon would usually stay locked at that lower price. The tech giant reportedly made over $1 billion in revenue through Project Nessie. I mean, this is something that's obviously we're hearing more and more about this coming out of this FTC investigation here. But Amazon's saying, look, the purpose of Project Nessie was to try and stop their price matching from resulting in unusual outcomes. That's how they're framing it. So they're basically saying that the FTC is mischaracterizing it. Seems like it's going to be a bit of an uphill battle, though, here.
Well, I mean, it's tough to say how this case is going to, shake down. Ultimately, we'll have to see what happens in the legal proceedings. But it does point to where the FTC is building its case after the announcement we got last week from Lina Khan. To your point about Amazon and its reaction to what has come out in this redacted portion reported by the Wall Street Journal, they're saying specifically this is not a tool that's already in use. They said they tried this for a bit. They realized that for a few years on a subset of products, it didn't work as intended, so they scrapped it several years ago. So Amazon essentially saying that, look, your arguments are, number one, outdated. This is not something we already use. To which, of course, we have heard from the FTC and Lina Khan say specifically that Amazon, because of its tactics in the long term, it did in fact raise prices broadly in the market. That hurt consumers. That's the antitrust argument they're trying to make, and something that we, of course, will continue to watch as this back and forth shakedown.
Indeed. Well, we still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah. Well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You got to do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. The Supreme Court heard oral arguments on Tuesday in a challenge brought by payday lenders against the funding structure of the Consumer Financial Protection Bureau. Those lenders arguing that the financial watchdog's funding through the Federal Reserve is unconstitutional and should receive appropriations from Congress, an effort to try to stop the agency from working. Though the justices seemed likely to uphold the CFPB's current funding structure in oral arguments, Senator Elizabeth Warren was the architect of the CFPB, and she joins me now in an exclusive interview for Reaction. Senator Warren, thanks so much for joining me. It's great to see you.
Thank you. It's good to be here with you.
Were you heartened at all by what the justices said during oral arguments? Do you feel more assured that perhaps the funding structure of the CFPB will be upheld and that the actions to date are safe?
Well, let me just start with a little bit of background. Remember, this is the agency that has forced the banks to return more than $17 billion directly to people they cheated. It handles more than 3,000 complaints every day. This is what tries to keep people safer on their mortgages, on their credit cards. And the folks who've resisted them the most are the big banks and the payday lenders, the ones who largely prey on our young military members, for example, who need a little money until the next payday and find out that they're often paying 300, 400%, sometimes even as much as 1,000% interest on these loans without understanding that up front. So the payday lenders brought this case. They claimed the problem is that Congress set the CFPB up so that the funding doesn't come through appropriations. Instead, it comes from other bank fees and so on through the Fed. The problem with that argument is that's the case for every single banking regulator. It's true for the CFPB, but also for the Federal Reserve Bank, for the Federal Deposit Insurance Corporation, for the OCC, for all of the bank regulators, and it's been true throughout our history, dating back to our very first banking regulator in 1863. So yesterday at least gave me heart that the justices seem to understand that if they knock down the CFPB over its funding, they got a real problem with everything else in the financial system. And then, just to make it worse, turns out Social Security is not funded through appropriations. Medicare's not funded through appropriations. So the Supreme Court, if it decided that the CFPB can't do this, they could upend not only people's lives, but also our entire economy. So I hope that makes the court more cautious and leaves the CFPB intact so it can keep doing its good work on behalf of the American people.
Yeah, to your point, Senator, I mean, what sorts of consumer protections would be exposed here? What would be obliterated? In some of the research I did, it seemed to be that if Director Chopra if the funding were to be found unconstitutional, Director Chopra, who sits on the board of the FDIC, would no longer be able to participate in a vote for the forthcoming capital requirements that have been proposed. So what is some of the fallout we could see if this funding structure was rendered unconstitutional?
So it's everywhere. And I'll give you just one example. The CFPB is the one that designs and monitors all of the rules around mortgages, home mortgages. That's important for consumers. It's also important, frankly, for the mortgage lenders to have a very clear set of rules that says if you follow these rules, you can package those mortgages together knowing that they're safe and you can sell them on to other investors. That's how the mortgage industry works after that big crash in 2008. CFPB was put in place precisely because of the cheating in the mortgage industry that had brought down our entire economy. So you're going to love this part. As much as giant banks and the payday lenders have not liked the CFPB because it cuts into their profits, the mortgage bankers actually put in a friend of the court brief to say to the Supreme Court, Don't mess around with the CFPB, because if you do, you could destroy the whole home mortgage industry. So anybody trying to buy a house, anybody trying to sell a house could find out that there's no longer a set of rules that apply. That means people can get cheated. It means you can't have a financing system that works and everybody knows that it works according to the rules. You could keep that up when you look at credit cards, when you look at student loan servicing, and credit reports right now. CFPB has just done a wonderful move on credit reports to try to get medical debt that is known to have really high error rates in it and not predict whether or not you're likely to pay your bills, to get that removed from credit reports. CFPB is doing work to help make sure that those credit reports, if they have false information, that they get corrected in a timely fashion. So it pretty much, if the CFPB got turned upside down, would touch the lives of everybody in this country.
And switching gears, Senator, House Speaker Kevin McCarthy was ousted from his speakership late yesterday. What are the implications here that you see? We've got another government funding deadline coming up in mid-November. Does it make it more arduous? And what does it mean for trying to get policy passed in this Congress?
You know, I think of this as we've got to focus on where the problem is. People say Congress is dysfunctional. Congress is not dysfunctional. We're doing our job over here in the Senate. We're working through our budget bills and other things that need to be handled. The problem right now is a handful of Trump loyalists over in the House who think that chaos, that hurting American consumers, that damaging our economy, and undermining our standing all around the world somehow is going to help Donald Trump get reelected. And look at the difference now between Democrats and Republicans. Democrats had the House and the Senate and the White House in the first 2 years after Joe Biden was elected. And what did? We passed a huge infrastructure bill that's really paying off around the country. We passed the biggest climate package in the history of the world. We put in a 15% minimum corporate tax, $35 insulin. It started to cancel student loan debts, which, by the way, just this week, the president of the United States canceled student loan debt for more people. He's now at 3.6 million people who've seen some of their debt canceled. It's making government work on behalf of the people. What have the Republicans done since they've been in charge? In the year and a half that they've run the House, they nearly didn't raise the debt ceiling and put the United States government in default. And then last weekend, they nearly didn't fund the government to keep it open. And those are their two big accomplishments. Look, we got to have people in government who believe in making government work for the people, not just here to create as much chaos as possible because it might help Donald Trump.
Senator, we've recently just gone over the so-called childcare cliff, nearly $38 billion in funding for childcare that was put in place during the pandemic has expired. I know that you pushed to try to get a supplemental in for that in this last go around. With the next deadline coming up in mid-November for government funding, will you push again for a supplemental? And what is the appetite? Have you spoken with Leader Schumer about this? Given what's going on in the House, is there appetite to push this through?
So yes, I will be pushing. And yes, this is something that Democrats very much want to do. And I think we might be able to find some Republican allies if we can get the House up and functioning again. You know, I do want to say on this, we had a broken childcare market long before the pandemic. It was hard for families to find affordable, high quality childcare. It just wasn't out there. And childcare workers are paid near poverty wages. Then during the pandemic, it all fell apart. And that's why we put federal money in so those childcare slots would be there as mamas and daddies were able to go back to work. What this funding cliff means right now is that we're at risk for about 3.2 million babies to lose their childcare slots in the next couple of months because there's just not enough money to pay their teachers for those children's slots to stay open. Think about what that means. How many mamas are not going to be able to go back to work? How many daddies are not going to be able to go back to work? How many can't go back to school or continue the classes that they're in right now? How many babies are going to be parked in unlicensed centers where they're put in front of a television set with a whole bunch of other kids in front of, in someone's living room? Look, we need to invest in our children. And that means we need to make high quality, affordable childcare. And we call it childcare. It's early childhood education. We need to make this investment for our babies. We need to make this investment for people who are working. We need to make this investment for the businesses that need those mamas and daddies to show up for work. And we need to make this investment in our childcare workers who are doing some of the most important work in our country and not getting paid even a livable wage to do it. I'm going to push for more funding for this long term. I have a bill where we're just going to say, look, we've got to make a long-term investment. No family should be paying more than 7% of its income in childcare. Those babies are an investment in our future, and that's what we need to do as a nation.
All right, Senator, unfortunately, we're out of time, so we'll have to leave the conversation there. But thank you so much for your insight and hope to continue the conversation on this important topic of childcare with you in the future.
Thank you.
That's Senator Elizabeth Warren. You're watching Yahoo Finance Live. We'll be right back.
We are seeing a major disruption at hospitals across the country this morning as more than 75,000 Kaiser Permanente workers walk off the job. The stoppage marks the largest healthcare worker strike in U.S. history, with picket lines spanning across 5 states and Washington, D.C. The workers demanding better pay and investments to address a worker shortage. Let's bring in Kate Tulenko, CEO of Corvus Health. Kate, it's good to talk to you today. In many ways, some of the grievances being aired out right now really have rolled over from the height of the pandemic. How much of what we're seeing play out on the picket lines is specific to Kaiser Permanente? How much of it is symptomatic of discussions that are happening across the industry?
This is symptomatic to the industry, not just in the US, but globally. The US and most other countries globally have had health worker shortages and maldistributions for decades, and COVID just made that worse. And with the increasing inflation, we're just seeing that health workers are no longer able to afford to live. So that's why we're getting these strikes now.
And Kate, I want to ask you about the shortfall in healthcare staff. I mean, anyone who's tried to make an appointment with a doctor has seen what some of these wait times are already like. How much are we talking numbers-wise in terms of the shortfall in the US for health staff?
Well, for nurses, it's estimated to be about a 1 million nurse shortage, and it will take decades to train enough nurses to fill those needs. And one of the big challenges is that health workers take longer to train and are more expensive to train than any other skilled workers in other sectors, such as IT, engineering, finance, any other sector. And we see that in these Kaiser union positions, 1 in 10 positions is empty. And so that puts an extra burden on these health workers who've been working so hard all through COVID. They're not getting any relief. And I don't think that many people realize that certain health workers can be forced to work overtime. For example, if you're a nurse in a hospital and your replacement doesn't show up, sick or late to work, you're forced to stay and work that extra shift. You might have thought you were going home taking care of your children. And so the burden that health workers have, from an emotional point of view, the physical point of view, occupational injuries are extremely high in the health sector, not to mention all the work on weekends and holidays. It's a very difficult sector to work in, and the health workers are requesting more compensation and, more importantly, more help in doing this work.
Yeah, that number you pointed out to 1 in 10 in terms of vacancy. I mean, that is really striking. What does that mean from a patient standpoint? I mean, you talked about some care that's being compromised. To Rochelle's point, we have noticed the longer waits, but what is being overlooked in the process?
Right. So the most important issue is quality, particularly mortality rate or people dying. There have been very good studies that have shown that for every additional patient that a nurse has, the mortality of all of her patients increases by about 10%. So it really is a life and death issue. And also, of course, it's a vicious cycle because the more nurses and other healthcare workers are stressed by short staffing, the more people leave, the more short staffed they are.
And so then in terms of some of the solutions that have perhaps been offered by some of these health organizations, what meaningful progress have we seen even before, as you mentioned, there was already a shortage, but especially at this pivotal point now?
There hasn't really been any progress. There's been some progress at the margins. In fact, Kaiser in some ways has been a leader. They actually opened their own medical nursing school, particularly to get health workers that spoke certain minority languages such as Hmong and Vietnamese. But the big problem is with the regulation of the system training health workers, and that it's just so expensive. We're not investing enough. We really do need to train more health workers, particularly in rural areas and amongst medically underserved communities, such as the African American community and the Latin American community, because these are the very communities that need health workers most.
In this particular strike, we're talking about 8 unions coming together collectively to represent more than 75,000 workers. To what extent are we likely to see a spillover effect? What are some other hospitals, healthcare workers that you're eyeing that you see could potentially follow suit?
Well, we have had more than a dozen healthcare strikes so far this year, and I expect us to have more. And it actually is paralleling other industries as well. I think there are a lot of parallels with the auto industry. We see that the CEOs are making thousands of times more than the frontline worker, and it actually compromises competitiveness. There's a quote from Lee Iacocca, the former CEO of Chrysler, in the 1990s, saying that healthcare costs in the U.S. Add $500 to every car manufactured in the U.S. And that's because our healthcare has been so expensive. We need a radical rework of our healthcare system. Health worker salaries are the #1 budget item in any health system cost. And of course, their practice patterns drive quality of care and drive everything else, patient satisfaction. So we really need to get this part right. And we can't just do Band-Aid solutions. In addition to training more health workers, we need to put childcare on site in hospitals and health facilities. We need to make working conditions more humane, shortening hours, making teams larger, adding more assistants on teams so that people can practice at the top of their license. We see many registered nurses, many of whom are at the bachelor's level, changing bedpans. That is not a bachelor's level skill. There are good studies that show that when a patient rings the call bell, the vast majority of the time, it's not for a nursing level skill. It's for something minor, like handing them a magazine or helping them to the bathroom. So we really need a radical rethink and a radical redesign of the American health workforce.
Well, certainly the voice is being held loud and clear at the moment. Hopefully this gets the attention it deserves. Appreciate you taking the time to join us this morning. Dr. Kate Telenko, CEO of Corvus Health. Thank you so much.
Thank you.
Well, the markets are down, but there might be a bright spot growing. There were 69 new ETFs hitting the market last month. For more on the ETF boom, Todd Rosenbluth, Verify Head of Research, is joining us now. Thank you for joining me this morning. So break this down for us. Obviously, when you have this raft of ETFs coming to market, it could be hard to decipher which ones are the most promising here. Where do you see the most upside in this rush that we're seeing in ETFs?
Yeah, so we have over 3,000 ETFs trading in the United States today. There's a lot of them. There's a lot of good ones. We're continuing to see new ones come out on a monthly basis at Verify, and we're trying to track the coverage. What's exciting to me about what we're seeing in September is that we have some established asset managers that are continuing to build out their lineup. So we've seen iShares expand their fixed income universe. We've seen JP Morgan expand their options-based, equity-oriented ETFs. We've seen Capital Group that has a suite of active ETFs bring new products out to market. I think we're going to go into some of those in depth, but it's just exciting to see some of these large asset managers further commit to the ETF marketplace.
Yeah, Todd, to what extent have we seen this demand increase as a result of the choppiness we've seen in the market? We've heard so many of analysts that have come on the show to say, look, it is about diversification. ETFs offer that.
Yeah, so there's a couple of key trends that are happening in the U.S. and certainly in the U.S. ETF marketplace. We've seen a need and interest in income. Fixed income ETFs have been punching above their weight this year. Roughly 40% of the overall flows in the first 9 months of the year have gone into fixed income ETFs. They represent roughly 20% of the overall ETF pie. So it's exciting to see iShares, which is actually having a stronger year for fixed income flows globally than they did last year. $82 billion globally has gone into iShares ETFs. They've expanded their TIPS suite of products. So inflation protected securities, they now offer individual maturity year products that are available for investors that want to manage their duration. So that's exciting. From a defensive standpoint, the market is still volatile. We've seen JP Morgan launch an ETF in September. The ticker is HELO. I would pronounce it as hello, just take out one of the L's that's there. This leverages some of their active management capabilities and use of options that they've had a strong presence in the mutual fund market, but also with ETFs like JEPI and JEPQ. This new ETF from JP Morgan is more downside protection oriented. So excited about that in the marketplace.
And in terms of who's investing, the sort of demographics here, are you seeing more institutional investors than also taking on ETFs versus, say, retail investors who are a little more cautious about going in for individual stocks?
We are. We're seeing institutional adoption of ETFs continue to pick up, whether that's insurance companies, that's hedge funds, that's other institutional investors. There's a lot more use cases for ETFs than there were beforehand. And now, because of the efficiency, the liquidity that ETFs provide. We're certainly seeing it within the fixed income marketplace, but as firms, in particular Capital Group that I mentioned earlier, they expanded their lineup of ETFs. Active management is something they're known for. They now have an additional 5 products that came to market in September. These are institutional level managers. You now can tap into them and benefit from the ETF marketplace.
Before we let you go, Todd, we got to get another pick from you. You mentioned the fixed income ETFs that have really seen some significant inflows, but nearly 70 products on the market in the last month alone. So what's another one that you think investors should pay close attention to?
Well, I guess I'll go with something that's a little bit more established. We've seen strong interest in MUB, which is a municipal bond ETF. This has got a long history, but it's just exciting to see investors turn towards the ETF wrapper. MUB is the iShares municipal bond ETF, very low cost, very well diversified for tax efficient and tax minded investors.
Not every day we talk about fixed income and muni bonds, but that's exactly where we are right now. Todd Rosenbluth, FedIFI Head of Research, joining us as part of our ETF report brought to you by Invesco QQQ. Great to talk to you today. We've got all your markets action straight ahead. Stay tuned. You are watching Yahoo Finance Live. The International Monetary Fund calling on the private sector to shoulder the cost of climate investments this week, saying governments alone cannot risk high debts, particularly in emerging economies. That warning comes ahead of the IMF and the World Bank's annual meeting in Morocco next week. The fund now estimating $5 trillion in investments will be needed annually by the end of this decade to reach those emissions targets laid out in the Paris Climate Agreement. Let's bring in Axios senior climate reporter Andrew Friedman to discuss more. Andrew, it's good to talk to you today. This is an interesting one from the IMF because this comes at a time where we have seen huge inflows in investments stemming from the IRA, the subsidies in the U.S. also being matched by European subsidies. Has that put the emerging economies in a tougher spot because they just can't match the level of investments that are being placed in developed economies?
Yeah, you could look at it that way. It does put them in a tougher spot, but it also puts them in the spot that I think most industrialized countries knew they were going to be put in. And it's been long known and talked about in the climate negotiations and in multilateral institutions that there needs to be a huge uptick in private sector money flow, as well as MDB money flows between the developed and the developing world. And that's long underpinned the climate agreements going all the way back to Rio in 1992 and going back to really the agreement that we talk about today, which is Paris in 2015.
So then you have to wonder then, what actually moves the needle on this? Because a lot of these things are not necessarily required by law for these companies and private companies to do. So what actually ends up moving the needle so that we don't end up having the same conversation about this burden being disproportionately on some of these emerging economies?
So a couple of things. One, there's a huge trust deficit, even just between the industrialized countries and developing countries, because the US and other major countries have not met their targets for aid that they promised back in the Copenhagen Climate Summit, which I've kind of blocked out of my memory because it wasn't it was kind of the most chaotic one that there has been. But you know, what does move the needle? I think it's a combination of bank reform. By this, I'm talking World Bank. I'm talking the way the IMF lends money to other countries. I'm talking about policies that they can put in place that would really incentivize the private sector to participate more in some of this. And obviously, the private sector isn't going to participate for nothing. They absolutely are going to be looking to make money and to figure out how to improve these money flows in the absence of mandate. And I think a lot of emphasis has been going into this and a lot of creative thinking on the part of US climate negotiators, European governments, and some others. And, you know, there have been these partnerships now with South Africa. They're working on Vietnam, also Indonesia, where essentially industrialized countries are paying developing countries to try to decarbonize their power sector in particular. And those money, you know, these deals get really complex. They encounter delays, they encounter corruption, but they're really critical if we are to meet the Paris targets. So there's, you know, a lot of talk of we're all in this together because climate change is not a national issue, it's an international issue.
Yeah, Andrew, you know, what do the fund flows look like from the private sector going into climate investments? I'm thinking back to COP26 when there were these huge commitments made by major corporations. Has that actually followed? Are they willing to take on that risk, given that some of the solutions that have been proposed, you know, just haven't proven out just yet?
Yeah, so, you know, I was talking with reporters and editors at IXIC the other day, looking at all the commitments that were made at Glasgow, thinking, well, what exactly happened here? There's been progress on methane emissions reduction. Even the United States and China are somewhat cooperating with each other on that. But the private sector money flows are not quite living up to some of these, some of the promises. The public sector funds have not really been there either. So, you know, if you look at these climate change negotiations, that they occur on different levels at the same time. You know, there's the upper level political theater, so to speak, and then really a lot of the work is happening on finance. A lot of the work is happening on trying to figure out how to scale private sector investment and recognize, you know, what you can get out of it, because the technologies that we need to scale in, say, Africa and parts of Asia are getting them to replace coal-fired power plants and not build them, and in return, get more access to solar technologies and wind technologies with battery storage. A lot of it is the technology that's really coming online now and is being encouraged through tax incentives and direct investment under the IRA in the US and under the European Green Deal plan. But I think that, we're still at this early stage where they need a couple of $1 trillion per year by 2030. And we're talking about, current money flows in the hundreds of billions.
All right, well, appreciate you breaking that down for us. Axios senior climate reporter, Andrew Friedman. Thank you so much.
Thank you.
All right, well, Katy Perry is roaring back into the spotlight with a new law that could have an impact on how housing negotiations are arranged and handled. Let's bring in Yahoo Finance's Danny Romero to give us those details. So, Danny, what do we need to know about this, and how did Katy Perry get involved here?
Rochelle, we've heard that saying, don't make decisions when you're angry and don't make promises when you're happy. And there's some relevance to that saying in this legal battle between pop star Katy Perry and founder and entrepreneur of 1-800-Flowers, Carl Westcott. Carl is suing Katy Perry and trying to stop the sale of his home. Katy Perry and her partner, Orlando Bloom, purchased this beautiful Santa Barbara mansion for $15 million in July of 2020. But only days after the deal was finalized, Carl changed his mind. And to give you some context, Carl was diagnosed in 2015 with a brain disorder and only lived in that mansion for 2 months before he decided to put it up for sale. Now, Carl Westcott and his family are spearheading a new housing act called Protecting Elder Realty for Retirement Years Act, or also known as the Katy Perry Act. And that was launched this weekend. And the purpose of this act is to establish a 72-hour grace period for certain real estate sales and transactions. The act has gained momentum both on a state and local level from representatives. But remember, for a bill to pass, it needs a majority vote, 21 votes in the Senate and 41 votes in the Assembly. Rochelle?
So what's the likelihood, Danny, of this passing? I mean, what are you hearing on the ground?
I think this honestly highlights the importance of elder fraud and elder financial abuse, how it is a serious issue in the U.S. The FBI says that online fraud targeting seniors has increased 400% over the most recent years. And the Federal Trade Commission also reported that in 2020, seniors had reported filed more than 100,000 complaints, and some of those some of them were fraud and could estimated to exceed $500 million. Now, again, like I said, for this bill to really gain momentum and to pass, it still needs 21 votes in the Senate and 41 votes in the Assembly. But I think it really does highlight that there isn't an act right now that protects seniors when it comes to real estate transactions and sales. So if this act does gain momentum and pass, which it could happen, then it would really make an impact in the housing sector, but also for retirees, Akiko.
Yeah, interesting dynamic playing out in the housing sector there. Danny Romero with that report. Thanks so much for that. Well, layoffs are expected to hit Meta Platforms today. The tech giant is planning to cut an unknown number of jobs from its metaverse-driven Reality Labs division. That's according to a Reuters report. The unit currently has around 600 employees. And Rochelle, this Reuters report specifically saying that the cuts are likely to come in the chip-making unit. But the broader question this is certainly going to point to is, where does this bet that Meta made on the metaverse stand right now? On some level, you could argue some of restructuring was expected when you consider that a new head was put in place within this particular unit. But I can't help but think of the losses that the company has been reporting here. $3.7 billion in operating loss in the last quarter, $21.3 billion in losses since the beginning of the year. Is this about Meta getting its financial house in order so they can continue that bet in the mixed reality space, or is it about downsizing a bet? That's a big question I think investors are going to be asking.
And I think it might be a bit of both. Obviously, Meta declared this its year of efficiency, so really honing in on some of the areas where it needs to cut. It made this big bet on the metaverse here, and as we look at some of the cuts here, we're expecting to see them to the silicon unit called Facebook Agile Silicon Team, or FAST. So it could, we don't even know how deep some of these cuts are going to be eventually, but it does make us wonder then, what does that mean for their augmented reality and virtual reality push that they have, which is a huge part of the metaverse. Zuckerberg was touting the importance of having meetings in the metaverse. So it'll be interesting to see how those investments are going to change. You know, they've been pushing a lot more focus on AI and generative AI than they have been on the metaverse here. So some adjustments here, perhaps some fine tuning on these investments, but still early days here. But as we mentioned, this year of efficiency, so a lot of changes could be on the table here.
Yeah, the year of efficiency is certainly probably key in terms of trying to understand where these cuts are likely to come from. We should mention the company did just launch or announce their Quest 3. You know, you think about the competition the company faces, at least on the hardware side, from the likes of Apple. Meta seen as more of an affordable offering. You know, it's a different use case that we're talking about, and they have made that big bet. I mean, they changed their company name because they wanted to place that big bet on the metaverse, mixed reality specifically. So this certainly doesn't mean that they are, you know, giving up on it by any means. The company has said that they are invested in it for the long term, but maybe a bit of reassessment that's happening here, maybe some rescaling as a result of the huge investments they had to make upfront.
Indeed, definitely being more strategic there. Well, we're heading to the new now, so let's give you a final check of the markets before we go. Still, as we see there, we're seeing it was a mixed picture earlier, currently in the green here across the board, but ever so slightly. The Dow up about 0.25%, about 76 points. The S&P 500 also gaining some ground here, up about 0.5%. Tech-heavy Nasdaq also up about 1% on the day. All three major indices touching session highs at the moment after that weaker private jobs data came out from ADP. And of course, we'll await the big jobs number coming out from non-farm payrolls on Friday as well. Well, that does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Thanks for watching and stay with us on Yahoo Finance.
The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance. All right, thanks, guys.